Hi, everyone. Welcome to Bitcoin Plus Plus Economics Edition. Appreciate all of you waking up and making it up into the hills of Vienna early this morning. Really excited for 2 full days of programming where we're going to be talking about people's differing views of Bitcoin as an economic protocol, both from the more academic side as well as the developer. I'm going to kick it off today by giving a little bit of an overview of my own journey into Bitcoin and quick overview though about Bitcoin Plus Plus. For those of you who aren't familiar, is this your first Bitcoin Plus Plus conference or event? Oh wow, okay, about half the people. Great, very excited to have you here. It's also our first time in Vienna, and it's our first time talking about specifically, this is our 16th ever conference. So while we've done a lot of events, this is our first one talking about economic things. I want to give a big thank you to our sponsors, NIDIG, the Human Rights Foundation, our big headline sponsors who make all of these events possible, along with Stacks, who really makes our workshops and seminars possible. Our Alaka Knit is our silver sponsor this time. We also have a variety of other sponsors. So thank you to everyone for showing up and contributing to helping make all of these events across the globe possible. Like I said, we've been a lot of places, but this is, again, our first time in Austria, our first time talking about economics. So just a little bit about me and my background and why I'm particularly excited about this event. Generally, Bitcoin Plus Plus is a developer conference series. We focus on bringing developers together to talk about what they're working on in Bitcoin. I myself started off as an engineer coming at Bitcoin from a technical perspective. This is where I kind of learned to really like Bitcoin. How many of you guys have read the white paper? And how many of you are developers, I guess, or would self-denominate? So most people who come to Bitcoin read the white paper, whether they're developers or not. So I like to think of this as a very good founding document. I was no different. This was one of the very first things that I read when I was getting into Bitcoin. I quickly got kind of down the rabbit hole about learning about time chains. Has anyone read this paper? No, okay. Bitcoin time chains is a protocol for keeping track of time using blockchains. I got really into a bug that I found in Bitcoin, the Y2K bug. Did anyone know that Bitcoin has a Y2K bug that we'll have to fix? It's a handful of people, probably the same number that are developers. So this was my interest in Bitcoin, was as a protocol, what's going on. I made a game that shows off how the protocol works. And then I started going out as a developer and going to bigger conferences and meeting other people that were also interested in Bitcoin for completely different reasons. And I realized as I was talking to people maybe that came to Bitcoin for not necessarily all the technical reasons or because it was such an interesting protocol, that there were other people that were here for reasons such as this thing called hard money. How many of you have heard of hard money before? This is not, okay, that's more people than were developers, great. And it's like, wow, okay, Bitcoin is really bringing together people and other people that were here because they like something called game theory. And so it's like, wow, Bitcoin is really fun because it's kind of this big tent. It's bringing together a lot of smart people who are coming from different sides. And you start to realize that what Satoshi has done is really pretty novel and interesting. And then he's taken what is a very smart way of looking at computers and engineering, and he's married that to something that he's taken hard computer engineering, and he's married it with something that I like to call incentive engineering. So if you talk to just your normal run-of-the-mill developers, not very many of them are very, I would say, skilled particularly. Oh, you guys can't see. Oh, it went away. Okay. I think I'm trying to say it's a rare skill set, I think, to marry incentive engineering with real protocol engineering with computers, understanding both of these things at a very deep level. And so that's what we really have in Bitcoin. And so this, I hope, is an event to celebrate bringing of these two things together. I was doing a little research for this talk. This might be an embarrassing admission that I'm hoping to learn a lot about the Austrian school here today and this tomorrow. But I was looking at this, and I was very interested to see that that was actually something something that the Austrian school is very proud of bringing out is that it's also amount of incentive engineering. So I'm hoping over the next 2 days we'll learn a lot, both about what the academy says about the theory of economics from the Austrian perspective, as well as what computer engineers are building in protocols to make free markets and incentive engineering happen at the computer and interactive, the automated interaction level. So thank you everyone for coming. I'm really excited to hear about what all of our speakers are working on and what everyone in the audience is thinking about in terms of how incentive engineering is working both at the protocol level in code as well as the protocol level in terms of law and how humans interact and talk to each other to make exchange happen. So thank you for coming to this experiment, which is Bitcoin ++ Economics Edition. I'm very excited to have you all here. Also, we have a merch store. There's some books. I also have hats. So it's my pleasure to bring Renee up to stage. I asked Renee to put together a quick talk about how engineering economic protocols. He's been spending a lot of time, particularly on the Lightning Network, which is all about how to incentivize people to move money. And so he's here to talk about what he's learned from his research, and I'm very much looking forward to his talk. So if we could give Renee a warm welcome, I'm really excited to see what he has to say. So thank you.
Hello, everyone. It's nice to be here again and asked to talk about economics. That's not my major. I have done a little bit of research with respect to game theory recently, because that's relevant to Lightning. So I was delighted that Lisa asked me to talk here. So what this talk was supposed to be about, I want to talk about channel depletion yields lower reliability of payments, explaining that channel depletion is a result of asymmetric routing fees, selfish behavior of sending nodes, which is like game theory involved. Noting that a protocol change towards symmetric fees would fix this, looking at the bigger picture, realizing decentralized systems are less efficient than centrally coordinated systems. Right? This is a price that we are accepting to pay, a price of anarchy. That's the mathematical term for it. And protocol designers allows us to keep this price of anarchy low. And then we could do a case study of collaborative rebalancing, and Lightning does not have this, and so on and so forth. And this yields a market opportunity. So I thought this was my talk. And then I realized this is far too technical for this audience and for this venue. So I decided, well, scratch this. That's not what we're doing. So things I will not explain today, even though if you are technical, you can come to me and you can talk to me, or you can, for some of the parts, watch the Lightning edition talk that was recorded in October, is why selfish routing can deplete channels, why depleted channels reduce reliability, why asymmetric fees create directional liquidity pressure, why symmetric fees would be a natural protocol fix, why collaborative rebalancing is an obvious market opportunity, why decentralized systems accept inefficiency in exchange for sovereignty, and why protocol developers should pay attention to both game theory and mechanism design. Instead, I had a different idea for this talk, which still relates to economics of protocol design. So my big idea, what I think is a big idea, and I'm way out of my comfort zone here, so apologize for that, is as an independent researcher, I can say what I observe. I have no strings attached. I have nobody above me who tells me what to do. And the Bitcoin protocol's economics do not only happen inside the protocol. They also happen between protocols, startups, investors, and narratives around those. And this can be very frustrating for developers. It took me a long time to figure this out. Right? I'm coming as a technical person. I'm like, here's an idea, let's fix this. And people I talk to, technical people who would very easily agree, sometimes are like, no, we don't do this, because they have strings attached and there's an entire market and it's fuzzy and messy and it's complicated. So my conclusion of this is sometimes the optimal architecture is compositional, and while the reward narrative often is competitive, right? You want your protocol to succeed, you want your implementation to be the best. And what I want to do with you, I want to look at one specific example that comes to my mind out of my research, where I have some technical expertise, hopefully. And this is this debate. It's the Arc versus Lightning debate. And I think when you are online on crypto or Bitcoin Twitter, I should say, you often find this like Arc is the new payment system and is great for payments. And yes, it has some relation with Lightning, and we don't ignore Lightning. But I think these two protocols should work together, right? There is a much better framing that we can have. And hopefully after this talk, we will all have the same understanding here and know this. Okay, in order to do this, we have to look a little bit into Arc and Lightning. So I will start with Lightning, and I apologize for those people who have been at the Lightning edition. I will borrow 5 slides from my last talk. They're basically the same. I frame them a little bit differently because I don't want to give the whole technical talk. But the main problem of Lightning is that payments fail far too often. Everybody who runs Lightning infrastructure has observed this and knows this. And the reason for payments to fail are uncertainty about liquidity. There's a lot of research out there from 22, 23, where we basically have addressed this and we know how to solve this problem. And more recently, the mathematical theory of payment channel networks have explained how infeasible payments emerge on the Lightning network. We won't discuss this here. You can look up the other talk. You can just take my word for it now that this is another main issue. And one thing, as a node operator, it's hard to differentiate whether you're currently in this reason or in the other reason, right? It's basically technically not possible to see directly, at least. You don't get this feedback. And there are strategies to mitigate infeasible payments. What are these strategies? Well, first of all, you can provide liquidity via on-chain transactions. So you can close or open channels, you can do splicing, you can do atomic swaps where you like pay somebody over Lightning or receive something over Lightning, but do the exchange with an on-chain transaction. And of course, if payments on the network took place, I mean, swaps are a special case of this, but sometimes somebody pays someone and then, well, you get inbound liquidity for this. So if nodes send each other payments, the min cut for many nodes in the network may be changed. So the key concept here is, unless we rely on random luck to take place, infeasible payments require on-chain transactions. So, you know, we only have a limited amount of on-chain transactions. It's a problem. Block space actually limits the scale of Lightning payments. We thought initially, block space is limited, we just open a few channels, and then we have this like off-chain Lightning network where we can send money back and forth, and this scales to infinity. But you can show very easily, there's a very simple mathematical formula which says if you take the number of supported on-chain transactions per second, which is 7 transactions per second, and you divide it by the expected rate of infeasible payments, well, this is the number of Lightning payments you can achieve. So great, as a technical person, I'm like, well, it's just like lower this rate, but that's very hard to do. So there's a table in my research, and we're currently at a likelihood of feasibility of 97.5%. 2.5% of payments are infeasible when we try them, according to some experiments. So this means Lightning currently can scale to about 280 payments per second. I mean, that's better than Bitcoin for payments, but there is a limit to this, and that's what I basically want to recall from the other talk. So the question is, can we do better? Can we do something else? Well, maybe with some changes of the Lightning protocol. There's one conclusion: multi-party channels are the only really known fix to this, again, as proven in the mathematical theory of payment channel networks. But they are really tricky to achieve on the Lightning network. They are messy to implement. And it's not quite clear if we really, really want to go down this path. Well, then 2023, Arc enters the room. And Arc was introduced around a real Lightning pain point: inbound liquidity. That was the main issue that many people experienced. Me as a researcher, I would argue this is a special case of payment infeasibility, but let's not go into the like words, right? I mean, the point was identified correctly. And media and startup narratives quickly framed Arc as a new payment system. And that framing may create this impression of Arc versus Lightning, which some people experience. And I would ask, how did we get there? Well, we can look at how Arc was initially marketed by its inventor, Burak. So here's a quote from a CoinDesk article, which, I mean, CoinDesk writes in the third person about Burak, but it's very much along the line of what Burak said in podcasts. So I took this quote. He basically he confronted the myriad of problems currently besetting the network as he described them. Poor user experience, suboptimal privacy, payment routing challenges, and then the onerous liquidity requirements. He means the inbound liquidity problem. And well, then ARC became companies. Companies have VCs. So there's the framing of Tim Draper in the press release. Tim Draper as the lead investor of ARC Labs. And there's a key quote in the Reuters article. Today we have to focus not only on how to buy and store Bitcoin, but how to use it as a medium of exchange for everyday purpose, Draper says. ARC allows for seamless Bitcoin payments, he adds. And so the narrative is set. ARC is for Bitcoin payments, and Lightning apparently has not achieved this. And then there was a second round of ARC investment. Paolo Arino also confirms it's, for some assets on Lightning, but also for payments and stronger global liquidity and so on and so forth. And there's a second ARC implementation, second.tech. And if you go to their website, on the front page, they say, well, we enable Lightning payments painlessly, but Lightning is awesome, yes, we know this. But if you've ever built on Lightning integration, you know how brutal it can be. With Second, you can do Lightning without doing Lightning, right? It's like solving all these problems magically, right? So the fight is there, very apparently. Okay, so I talked about the pain points of Lightning. Well, let's talk about some well-known issues and challenges with ARC. Well, as with Lightning, there is the mass unilateral exit problem. If your ARC is big enough and you have to resolve this on-chain, maybe the time blocks are not sufficient to have like millions of people claim their VTXOs. Liquidity is actually needed to facilitate payments. What this means is, linear to the payment volume that is being facilitated by ARC, you need to provide liquidity as the ARC service provider. Well, I guess that's good for Bitcoin yield and credit markets, I guess, because some people want to like give their Bitcoin and see a market opportunity. But I mean, Bitcoin is also limited, so I don't know how well this will work. There's technical discussions around this. And I would also say it's questionable if it really can scale trustless real-time payments, because in ARC you always need for the batching round for payment to be settled. It's the same as zero-conf channels in Lightning. So it's really like, I mean, Lightning payments, they arrive directly. You get the pre-image and it's done. And in ARC, you don't have the similar experience without trust, as far as I know. There are teams working on this, of course, right? And I would argue the privacy is poor, as the ARC service provider sees everything. I mean, he's co-signing every VTXO, right? So, I mean, this initial fight that Burak took where privacy may be an issue, I mean, I don't see it. And there's no open standard. There's centralization pressure. The winner takes it all. I guess that's the big hope of VCs. I don't know. And there's this stupid narrative to connect various ARCs via two-party Lightning channels. Anyone in the audience, what's dull about this narrative? It has the same limits, right? I mean, it's like, if Lightning worked so well to serve this, then we wouldn't need ARC, right? So, I mean, it's kind of like, it doesn't even make sense. So at the end of last year, I was excited to share a technical report where I basically elaborate why I disagree with this narrative, and where I argue that ARC actually serves a very, very, very good use case if you understand ARC as a channel factory for Lightning. Because as we just recalled, the main pain point in Lightning is that payments are infeasible and you need on-chain bandwidth to do this. If you could create funding transactions for channels within the ARC, well, then you have taken load from the chain. So I think that's a debate we should have. So I published this, and I will argue why this is the way to go. Well, to make Lightning reliable, we need to scale the number of transactions, as we just discussed. And if open and closes in ARC, we can save block space. And this scales the number of topology operations that we can do on the Lightning network. And this helps us tremendously because we can now do this. So ARC is much better as compressed Lightning infrastructure than as the last mile payment system, as we just discussed, because the payments are not really real time. And in Lightning, we already know how to do them. And by the way, already today in Lightning, we wait for block confirmations for channels to become active. So waiting for the ARC round is equivalent. So we lose nothing, but we win only. Because we have the chance that this opening and closing transactions are also off-chain. So force clauses on the Lightning Network could also be resolved within the ARC, right? Force clauses are currently very expensive on the Lightning Network. Well, if the ARC service provider is there as an intermediary, you can maybe resolve them. Would be really nice. Payments are still onion routed and not visible to the ARC service provider. And much more importantly, a channel factory is basically a multi-party channel. And I discussed before that multi-party channels are the only, at least to me, known mathematical proven argument to resolve the payment infeasibility issue in Lightning. So it combines the best of two worlds. Yeah. So this idea I already had in the very beginning when ARC was introduced. So this is a tweet from 2023 where I thought, well, maybe that's a possibility. Now, 3 years later, I'm very sure and have done the research to be able to say confidently, initially it was an idea and observation, but I think that's actually really the way we should go. And to be fair, I talked about the ARC implementations. Here you can see Eric de Smet with me, and there were 2 other people on the stage in Bitcoin Amsterdam, and we were discussing ARC as a potential infrastructure for Lightning. And if you look closely, he was wearing a T-shirt saying "The Channel Factory." Right? Eric de Smet is the CTO of Second.tech. So I mean, he technically understands that there is a case to be made to use ARC as an infrastructure layer for Lightning. And other technical people agree. So here's Christian Decker last week, or 2 weeks ago, I don't know the date, recently, discussing that he complains about the apples and oranges of how ARC is being marketed in comparison to Lightning and how they're different and not. And again, Eric also says, well, you know, I never bashed Lightning, and Christian agrees, yes, the technical folks, they are actually really nice here, but you know, it's not only the technical people all the time. So back to the topic, what about economics? Well, technical people can be serious and honest about ARC and ARC's limitations, same as with Lightning. And Lightning has real problems that ARC can help with, as I just have tried to explain on a high level. And the misleading part, in my opinion, is often the product narrative around this. It's like the ARC replaces Lightning, and there's no channel management needed, which is so complicated and confusing. And in my humble opinion, this is not a protocol dispute only, it's an incentive dispute. Right? The new payment system is much easier to market. And infrastructure for an existing open protocol, that's very hard to sell. It's like, who would give money for this, right? And startup economics often reward competitions. Like, you go into the competition and you make the better product. So let's recall the billionaire Tim Draper, who makes this key quote. And I emphasize the billionaire, right? He must do something right. I mean, he's a very successful investor, and obviously his strategy often was beneficial and good for him, right? So let's recall his his quote. And I want to add, I agree with Tim Draper's vision. Bitcoin should become a medium of exchange for everyday payments. But neither ARC nor Lightning alone will get us there. Fighting to win today's small Bitcoin payments niche is short-sighted. I suggest to use ARC where it excels as a channel factory infrastructure for compressed liquidity management to scale Bitcoin payments via Lightning. Right? Because in this way, we can actually make Lightning so usable that not only a small niche of nerds and hackers and developers are using it and fighting for a non-existing market, but really make it, hopefully, a global payment system. So for the technical people who like layer cakes, this is how it could look like. It's really amazing what the AI can currently do. And I think humans think in visuals, so take this, and with that, I conclude my talk. Thank you very much.
I think you are right in terms of blaming narratives for what's going on. And I think it's actually from the structure and the layers which you said, we need to flip our thought. Right now, the narrative of Bitcoin, the dominant one, is the Saylor narrative, the store of value, the pristine collateral. Yeah. And I've met already a couple of people who do endorse the medium of exchange purpose. But your calculation of the 280 transactions had some very specific assumptions, which, so to say, you contradicted yourself, because once you go on ARC nodes to be connected via channels, you get very, very different transaction and payment capabilities. So for instance, there are multiple technologies who can do the, let's say, the coffee level payment as medium of exchange. And for instance, if you had, I don't know, 1,000 nodes connected by a Lightning backbone, those could essentially do very, very different transaction numbers. In fact, they could support something which is called in banking gross real-time settlement. Yeah? So I suggest, this is a great chart, but I think we need to put Lightning payments in between Bitcoin. And I think the narrative, which probably, in my opinion, will prevail, is Lightning as the backbone to connect service providers, whatever the service provider is on Bitcoin. Could be Arc, there are other things around.
Yeah. So, first of all, I agree with your observation that the 280 payments per second are in some sense misleading if you look at everything, right? I mean, if you say a Lightning payment can be like some custodial wallet or some non-custodial wallet, like whatever, right? Like some other services, even an Arc service that does it. Yes, but I'm talking isolated protocols, isolated technologies, which ones are good? And for that, the 280 calculation is absolutely sound. That's, I mean, with the given current rate of infeasible payments that we observe. And by the way, if the Lightning Network were to grow, you can show mathematically that the rate of infeasible payments is actually worse. It's getting worse, right? So we do have problems here. With respect to the layer cake, I do understand that a lot of people want to see the Lightning Network as the settlement layer between services. But I strongly disagree on this. I think the Lightning Network is actually a very good payment system, and we need layers between Lightning and Bitcoin to make Lightning better. But that's me as a technical person, maybe dreaming my dream.
Thank you for your talk. I want to go back to this 280 number of transactions.
Yeah.
I guess to calculate that, you have to take into account that there is a specific liquidity in Lightning today.
There's a specific what in Lightning?
Liquidity.
Yeah.
So my question would be, if Lightning was more popular, so you had more liquid channels, would that be a better number or not? So where does this come from?
Yeah. So this number currently comes from the fact that we can do studies and make like payment attempts and see how often these payments were infeasible, given a current topology. Several people have done tests and ranged in numbers, right? I mean, I picked the 97.5. I could have used different numbers as I did here and result in different, you know. The general observation is, and there I refer you to my talk from October, is when the Lightning Network gets bigger, which also means more liquidity, the rate of infeasible payments actually increases, right? So the problem is getting worse.
It depends on what you mean, because you can increase, let's say, the liquidity per channel,
Sure.
or include 5 hubs,
Yeah.
and that would help a lot. Or you can increase liquidity by adding more channels, which fragments liquidity, and this is worse because you need multi-hubs and so on.
Yes. So generally, I agree. A bigger network is the problem where the infeasibility rate drops, but more liquidity per channel, of course, makes the channel to live longer, but that's more addressing the depletion problem. The depletion problem, as I discussed initially, is the uncertainty in the Lightning Network. We can address this already, because if the channel is depleted, well, then another channel has the liquidity, right? So in that sense, the infeasibility problem is not necessarily fixed by the fact of, do we get bigger channels, right? To some sense, it is a little bit, but the general math doesn't change. I mean, you can, again, I refer to the other talk and to the paper. Yep.
Thank you. I have another question about the channel factories you mentioned. In channel factories, you need all the parties to cosign, so unanimous agreement. In Arc, you don't, right?
Yes.
So I think it's closer to something we call commit chains. Arc as a construction. So I'm not sure exactly how you want them to interplay. I didn't understand that exactly. So you enter in the funding and the closing happens in Arc.
Yeah.
So you top up in Arc. That's what you meant.
Yeah.
Okay. Thank you very much.
And this reduces the interactivity of a channel factory, right? So it's like a nice way of having like multi-party channels, but not everybody co-signing. Everybody just like needs to co-sign once in a while. But I mean, Lightning node operators already have to look at their node once in a while, otherwise their channel is being forced closed, right? So, like, yeah, it's naturally there.
Thanks for the talk. So you think that if we would have Arc in between and we have Lightning payments, how would you, because the problems would still be there, except you don't have the on-chain costs at more. So do you, what is then the level of transactions of like throughput you could realistically think, like, would it be enough, in your opinion, to buy the coffee?
We would certainly get like one step around again of this like on-chain bandwidth limitation. The question really is how big can these ARC communities grow, right? Because I mean, you have the mass unilateral exit problem. I haven't done the numbers and the research there, but I mean, you certainly get at least an order of magnitude of scale, very obviously. How much you really get, I wouldn't know.
And then maybe, because in ARC you indeed have a liquidity problem, in quotes, but it's in a way it's the same as in Lightning, except it's a more efficient way that you can divide the funds, right? Basically.
So the thing is, if you provide liquidity for a payment channel, the payment channel may not only be unidirectional, right? Like it can go back and forth, and like stuff is happening there, right? So what this means is the payment volume within ARC that you have to support for these like funding transactions is going to be lower, so it reduces the liquidity requirements. Yet the liquidity on Lightning is very valuable. I mean, people already pay for Lightning liquidity, right? So it's not taking profit away from somebody. I mean, again, you would have to do the exact models and numbers, right? I'm talking more from a technical protocol perspective here. But I think there's a case to be made here.
Is that in the, or is that what you do in your latest work, or is that future work still to kind of run the same kind of analysis?
No, I'm trying to understand how ARC and Lightning can actually work together, and yeah.
Okay.
Hello, René. Nice to see you. I agree completely. I think Lightning's pretty perfect, and it's actually the layer which it sits upon, which is imperfect for Lightning. And I always assumed there would be a layer between it. And you know, just so maybe some people might not know in the room when René talks about something like channel factories, that these aren't new concepts. Since the beginning of Lightning, we've always known its limitations and what we need to be able to have it work for everybody. My question was, if we have ARC Lightning, and then we have our a normal Lightning as what we have now, can I send a payment from our traditional Lightning network to ARC? Would the channels be able to communicate with each other without?
Yeah, so, I mean, to a first degree, yes. You may need some few changes in the Lightning protocol, because currently a channel on the Lightning protocol is anchored to an on-chain transaction, right, to announce the channel. Well, in ARC, it's a VTXO that's not on-chain, right? So we need to make this channel visible to the Lightning protocol. But I think that's a protocol change that is, I would argue, easy enough to get through if the demand was there. But then you can just seemingly, like, people wouldn't understand like where the channel is hosted, so you can interact these things, yeah.
That's fantastic, thank you.
Thank you. That's all the time we have.
I know. Thank you.
Cool, thank you. Next up, we have Kenneth, who's going to give us some more economics perspective on Bitcoin.
Yes, my talk is a question, or that I think Bitcoin developers, or any Bitcoiner for that matter, ought to ask themselves whenever doing anything. So it's a plea from a humble pleb to Bitcoin developers, because so where do I point this? Like here? Somewhere? The pointer, where do I?
Hit the forward button.
Yeah, but
Sorry, let me see.
where do I point it? Yeah.
Point it in this direction, and it has to be on first.
Oh, now it's on. Yes, I'm not a very technical person, as you see, so the on button was the problem. And yes. So, the ideal Bitcoin developer, according to me, is someone who's in the middle of these two circles. And it's arguably also the ideal pleb-slop monger, so I would be ideal if I was in the center here. Now, I'm more leaning towards this circle than that circle, and I'd love to come to this conference because I'd like to know more about that circle. So my hope for this conference is that I will be somewhere closer to the middle. And I hope that my talk will give you absolutely nothing of value, because I hope you're already in the middle of the circle. But in case it should do, I'm going to go through the basics of monetary economics here. And it should really say knowledge about catalactics, which is the Austrian economics term for economics. And Austrian economics is the real deal. The reason it is because you cannot argue with the Austrian arguments without running into a logical contradiction. So it's a bit like programming or developing like that, because computers don't like logical contradictions either, I hear. So, what are the two problems that money solves? At the very basics of what Austrian economics can tell us about money are these two things. Mutual coincidence of wants. In a barter economy, both parties are required to have exactly what the other person wants. So 3 goats for 2 cows requires one guy to have 3 goats and the other to have 2 cows. Otherwise, the transaction won't happen. With money, we mitigate that, and we now have something to sort of signal value with that does not require this mutual coincidence of wants. And the other problem it solves is economic calculation. Without a common medium of exchange, you can't compare costs or calculate profits and losses. So basically, you cannot have civilization without money. A barter economy never gets anywhere. And this is how we allocate resources rationally. And the more free market interactions there are with money, the more we allocate resources towards what people actually want. That's what money leads to. So it's the nervous system, the cardiovascular system might be a better analogy, but money is important. So I don't like the term store of value, because value, as Austrian economics tells us, is entirely subjective. Whether I value something or not is entirely up to me and in my head. So I prefer to use medium of exchange over space and time, because it gives a more accurate picture of what money ought to do. You can't really have one without the other. So I view it as a 4-dimensional medium of exchange. So when you hodl Bitcoin, you're actually trading with your future self. And when you use Bitcoin to trade with other people, you're using it as a medium of exchange over time. So it's temporal and spatial. Spatula. Yeah, anyway, saving is trading with your future self. This is, a way I like to think about this. Time preference is a word you've probably heard, and why time preference is important. The most basic example is Robinson Crusoe trying to fish in his ponds, freshwater pond full of fish. He has to use his bare hands. That's not very efficient. If he lowers his time preference and spends time constructing a fishing net, his output will be larger per time unit in the future. So if he can set aside a bunch of fish or capital and construct a net, then he can become more efficient in the future. And when you add other people to the mix and trade with one another, we can trade goods, consumer goods, and more specifically producer goods to advance civilization. This is why time preference is so important. And the quality of money directly affects a society's time preference. Bad money punishes patience and regresses civilizational progress. Good money rewards deferral, meaning we get more actual progress in society. Fiat is bad, Bitcoin is good. Yeah, deflation. There's a lot of myths about deflation. Fiat economists want you to think that deflation is a bad thing. But this is the greatest lie ever told, in my opinion. Deflation is perfectly good. Bitcoin is money working correctly for the first time in history, it says here. And that's to say that denominated in sats, at least theoretically, all prices can drop forever. So it's a completely new way of thinking about monetary economics. Like, the world on a Bitcoin standard is a very different place to the world on a fiat standard. And we can see in fiat land, everything in computing has dropped in cost, and in the price of computers, the price of phones, the price of, the price per megabyte has dropped drastically over the last 50 years, according to Moore's law, but we still buy more computers. We don't refrain from buying the stuff. So that's sort of an example of how distorted this view that we need inflation for people to buy things really is. So under fiat, productivity gains are stolen by the money supply expansion, funnels money from the have-nots to the haves. And under Bitcoin, productivity gains flow to every hodler, meaning that all prices drop forever. That's what that means. I like to view Bitcoin as like a lens to view the world through rather than anything else. Makes it easier. The destructiveness of money printing cannot be overstated for this very reason. If prices would be dropping forever, we would all be better off forever. And that is a reflection of resources being allocated better. So you've probably all seen this Milton Friedman thing with iPencil, that the free market somehow figured out how to make a pencil, even though there was no central planner involved. And this is like having money that is absolutely finite is the free market on steroids. Everything just gets better over time. This is why I believe so much in Bitcoin in the first place. This very notion of transactions per second, or that velocity of money is important somehow, that's a very Keynesian notion, meaning that that's what the government wants you to think. What they leave out, so the theory is basically, if I give you $100 and you give me something back, each time the $100 bill is traded between people, that amount of value is added to the economy. But this is a lie, because it doesn't include the leakage of the inflation. So that $100 bill is worth less and less over time, and it also incentivizes people to buy frivolous shit instead of buying producer goods, such as the fishing net, to increase their production per time unit later on. So there's no way to overstate how bad fiat is and how much better Bitcoin is if it keeps working. Yes, these are the 6 properties of money. I think this was already in ancient Greece that they talked about. I think Plato talked about this, not entirely sure. Bitcoin ticks off all the boxes, as you know. It's scarce because of the 21 million, forgeable costliness and all of that. It's scarce because it has basically, Bitcoin is, the way I see it, Bitcoin is the solution to the double spending problem, which I think is a problem you can only solve once. Once it's solved, you get this number on the internet that you cannot copy, and I'll get into the depths of that later on. Durability, yeah, UTXOs, they stay the way they are. Keys don't rot. Running a node remains affordable, and this is also an important point. Like, I think many people understate how node running costs are crucial to the system. Divisibility, yes, what Renee talked about, Arc and Lightning in that, is all super good. But also remember that fewer transactions is a part of the scaling solution. Like I view a world in the future where it's much more common with subscription models and stuff, because of purchasing power go up over time, every merchant will be more incentivized to get the payment early, meaning that when you go to the central station in Vienna here and put €1 to go to the bathroom in a little slot machine or blip your card, transactions like that will be more uncommon, and it will be more common to just subscribe to a lifetime of train rides through Europe. So I think actual fewer transactions per second at least on base layer, is one of the things that scales Bitcoin in the end. Portability, yes. This is, of course, in Bitcoin dependent on fees. If fees are high, it's not as portable, you could say, because it's costlier to send them. Otherwise, Bitcoin is very portable and can be teleported to the other side of the world. So even when fees are high, the thing you should compare it to is like sending a gold bar with an armored truck to Australia. So that's probably low for a long time. Uniformity, which is another way to say fungibility, which is sort of also in the eye of the beholder or quite subjective, is important for Bitcoin because sats are the unit of account in Bitcoin. So if Bitcoin is perceived to be something else than sats, then that is a problem because there's not supposed to be such a thing as a rare sat. Sats are supposed to be interchangeable always. They're not supposed to be valued differently each sat. And acceptability, which is the last one, I think acceptability is sort of a product of the other 5. And in Bitcoin, that's connected to verifiability, meaning that this is where the cost of running a node comes in. So we're all able to verify and validate all transactions if we want to. Yes, this is what the Austrians said about money. In short, Mises said that it's the most commonly used medium of exchange and sort of alluded to medium of exchange meaning of medium of exchange over time and space. He never said that explicitly that I know of, but it was sort of alluded to. Rothbard said it was accepted because hodlers expect, or holders, it says holders here, not hodlers actually, expect others to accept it. And he called it a good that is sui generis, meaning that it's not a consumer good nor a producer good, but a good that you hold strictly for the purpose of giving it to someone else at some point in the future. You can't consume it, you can't produce something with it, but you can use it as a unit of account and a medium of exchange and give it to others later. Hoppe, I think, had the best definition. He says it's the good that is supposed to reduce uncertainty about the future the most. So it's like an omni-insurance. If you have money, you're supposed to, be guarded against any future event because you can buy any good or service with it optimally. So we come to use cases for money. Gold has been money for like 5,000 years. And gold in jewelry and electronics is gold removed from monetary circulation. And this is an important point because the industrial demand for gold and the jewelry demand creates price volatility unrelated to monetary demand. So any other use case for gold actually makes gold a worse form of money because it gets priced wrongly. The use value from industrial use case is actually leakage. It diverts supply from the monetary function into consumption. And this is, of course, also true for Bitcoin. If the blocks are filled with other shit than monetary transactions, it becomes more costly for Bitcoiners to use it as money. And also more difficult for Bitcoiners to price the SAT correctly, which I think is a point that few people make. Use cases do not make a type of money better medium exchange over time nor space. That's the main point here. So we come to the more philosophical part of the talk, and that is, can sats actually be owned? And I don't believe you can own a sat, but I believe you can act as if you did. So if you think about what information money actually implies, this is what fascinated me personally about Bitcoin in the first place, is its promise of a number on computers that cannot be copied, which sort of defies everything I knew about computers. This is as outlandish as a time machine or something you cannot copy. So I thought about that a lot, and why can't you copy a Satoshi when you can copy everything else? Well, of course, you can copy the entire time chain, and you can copy all pieces of code in Bitcoin. But the reason you cannot copy the Satoshi is because the ability to move the Satoshi is not on computers, it is in your head. And this is true for every single Bitcoin that exists. Even, it doesn't matter if you know the actual private key, or if you know the 12 magic words, or if you know the location of your hardware wallet and how to unlock it. All of that is just a secret that you keep from everyone else. So we make a distinction between ownership and possession. So ownership is my legal relationship to a thing. So if I give you my shoe there, Thomas, you can choose to, I'm not going to give you my shoe, but you can choose to give it back or not. And so you're now in the possession of the shoe, but you don't own it. I still own it. And hopefully everyone in the room still thinks I own my shoe. So if you refuse to give it back, I can count on other people to force you to give it back to me. So this is sort of the difference between ownership and possession. But I view Bitcoin as being yet a layer deeper than ownership and possession, because all you can do is act as if you own it. And to be able to act as if you own the Bitcoin, you need three things. You need to believe that you are able to keep a secret from other people. You need to believe that it's very implausible that anyone else knows the same secret as you do. And you also need to believe that it's implausible that the system will change to such an extent that your sats become worthless. All of these three things need to be true for someone to actually take control of their own keys. And the third one is, of course, related to people actually running nodes and choosing what software to run on them. All good so far? You following me? Good. Yeah, Bitcoin runs on sats, not on dollars. The unit of account inside the protocol is satoshis. Fees and rewards are paid in satoshis. Miners might not pay their electricity bill in sats yet, but sats is what we pay miners in. The monetary quality of the satoshi is what makes the protocol work. So it's crucial for miners that sats remain money. If the quality of the money they're getting gets reduced in value, that undermines the entire system. So the sats need to be money, first and foremost. Non-monetary use cases are always detrimental to Bitcoin as money. Same reason gold's industrial use cases and so on was worse for gold. So, and this is also one of my pet things here. And a thing you hear a lot of stupid stuff from mainstream media. One of them is that miners solve really complicated computer problems and then they find Bitcoin or they create Bitcoin. Well, I think this view is wrong. I think the network pays miners in Bitcoin to provide them with a service. And that service is mainly providing Bitcoin users with block space to put their transactions in. And sort of the securing of the network is sort of a side effect of creating the block space. I mean, we want that too. We use Bitcoin because we believe these things work, tied to the whole implausibility of the system changing. But I think there's a much sounder way of looking at things. And mining on the whole can never be profitable. It's designed to not be profitable through the difficulty adjustment algorithm. And what this does is it makes seigniorage, this is a complicated word in economics, which basically means money printing. It makes that impossible. Issuance is fixed, regardless of hash power, making mining an overall zero-sum game by design. We should never care how Bitcoin miners make money. That is not our problem as users. We are paying them what we agreed to pay them for them to provide the service to us of providing us with block space. So the whole caring about miner revenue is, to me, I view that as a red flag. That is not my problem as the user of the network. Mining fiat is not a zero-sum game. Those who print it win. This is the Cantillon effect. We all know that's why all the money is in the US, because the consensus mechanism of fiat is, of course, world wars, and they won the last one. They had a guy called Robert Oppenheimer who figured out a way to utilize clever physics to change human incentive structures in a very, let's say, not very polite way, by threatening people to blow them up, and actually blowing some people up in the aftermath of the Second World War. Satoshi also find a way to, use physics to change human incentive structures, but in a much more polite way, where we're all incentivized to help one another. So this is why I prefer Satoshi to Robert Oppenheimer. That's an aside for sure, but yeah. Miners prove work to users, like proof of work. Who are you proving the work to? You are proving the work to the users of the network. Node cost is key. Bitcoin's monetary properties hold only if ordinary users can verify the chain. We won the block size wars, and we prevented this from happening. That I view that as a hostile takeover attempt. More than 90% of the big companies in Bitcoin, like BitPay and all the miners and stuff, wanted to change the protocol in a way that we didn't agree to, because we understood how crucial it is for a node to be cheap to run forever, because it's a forever problem. Node costs will go up in terms of storage, at least. Keeping node running costs low is the most crucial thing in Bitcoin. Yeah, so as I alluded to before, value is subjective. So we all have these value hierarchies in our heads at all times, and we prioritize one thing over another. They can always be ordered ordinally, but never cardinally. Meaning, if I move to the other side of the stage here, you can see that that was the most valuable thing to me right now. You can deduct that information from the fact that I did it, which is also why you should like follow the money rather than what people say. So if someone who's scaremongering about climate change buys a beachfront villa somewhere and at the same time claims that sea levels are going to rise with like 100 meters, then his actions speak louder than his words. So value is entirely subjective, meaning that human beings value things, people will value sats higher if they perceive them to be good money. At least Bitcoiners will. So economically literate Bitcoiners believe, or rather I would say understand, that turning Bitcoin into Ethereum 2.0 will kill it. If they perceive this is what Bitcoin has become, they will leave. They will choose something else, and they will not run nodes anymore. Or they'll run some other node implementation. If they think nodes don't matter anymore, they will leave. This is why it's so crucial for Bitcoin to still be Bitcoin and not evolve into something else. It needs to be money first and nothing else. If it pays a fee, it's legitimate, is an argument I hear a lot. Fees compensate miners, and the fees are paid by all Bitcoin's users. So as a node runner, if you're not mining, you don't get a share of that. You only bear the cost. So they don't compensate node operators, which means that the fee market doesn't capture the full cost. It doesn't give you the full picture of what actually secures the network. So fees tell you what miners are willing to accept. They tell you nothing about what users are willing to accept. There's a distinction there. The free market will fix it is another argument you often hear in these debates about what direction Bitcoin ought to take. And yes, that is true, but people buying hardware and running software is the free market fixing it. So that 20% of the network now runs NOTs nodes instead of core nodes, for instance, that is the free market. That is a free market phenomenon. We have voluntarily chosen to do that. So consumer decision. So proof of work is there to make it costly to break the rules. It's not there to mitigate spam or anything like that, which I believe was Adam Back's first idea with the hashcash thing. That never got implemented. Proof of work in Bitcoin is to make it costly to double spend, to make it costly to break the rules, whatever rules we agree on. So ultimately, consumer decisions decide which rules. In other words, Bitcoin is backed by human action and not energy. It's not energy money, it's human money. So where's the line? Like, so my plea to all the developers, regardless if you're a core developer or whatever, if you're developing wallet software or anything adjacent to Bitcoin, is just keep this question in the back of your head. Does this make Bitcoin better money? And if it does, so yeah, a hard case, programmable multisig inheritance. Serves a monetary function? Yes, unless it clogs up the chain too much. But many of these things are totally legitimate. What doesn't pass is block space consumed for purposes that have nothing to do with Satoshi as money. So no spam is money. Like all of that, regardless of how easy it is to work around and stuff, we should all view it as bad for Bitcoin as money. So the question to keep in the back of your head, does this make Bitcoin better money? There's really 4 questions in one. So question number 1, does this feature serve a monetary function? If yes, you're all good. Second one, what is the feature's true cost? And here you need to weigh in at all times the long-term cost of running a node, which is the most crucial thing. So is it worth it? Everything in Bitcoin is trade-off, right? Segwit was a trade-off, Taproot was a trade-off, everything's a trade-off. Who bears that cost? Super important. If it is node runners, it's probably not a good idea, or you should think twice. So is the benefit worth it? Does this make Bitcoin better money? I know I'm repeating myself here, but yeah, I was running out of inspiration. This is like slide 17 or something. Anyway, so the plea is, I'm not asking you to become monetary theorists. I'm asking you to let one question live in the back of your head at all times. When you're reviewing a PR, when you're sketching an opcode, when someone pitches you a cool use case. And this goes for me too, by the way. When I invite people to my podcast, I ask myself the question, does this make Bitcoin better money? Which is why I don't interview Vitalik Buterin, for instance. Or Christine Lagarde, for that matter. I don't think such an interview would make Bitcoin better money. I like to interview people who are diplomatic and willing to discuss things from an honest position. So, I have picked a side in this whole core knots debate. As many of you know that I'm more on the knot side than the core side. However, I do think there are people with good intentions on all sides, and there are people with bad intentions on all sides. There are good arguments and there are bad arguments. And if you, for instance, so there's a follow the money thing in that too. So if I know that the person is making what sounds like sound arguments, but it's then also making money off of being invested in a company that spams the chain, then I'm not going to take that person's opinion seriously because I know it has a vested interest in stuff that is bad for Bitcoin. So that's how I try to filter, pun intended, who I'm willing to talk to. So just keep this question in the back of your head. Does this make Bitcoin better money? And I hope I will learn a lot from you. Hope you didn't take away anything from this. Hope you knew it all already. Thank you. We have 40 seconds for questions.
That was great. It's embarrassing to admit, but I did learn something, so thank you. I had a question for you, maybe about you were talking about how things should become cheaper over time if you're a Bitcoin holder. I wanted to ask how you see that playing out with like AI tokens. So right now as a developer, I'm spending a lot of money on tokens for getting LLMs to do things for me. And I think maybe that's a good example of like a new technical innovation that we're now spending money on to do productive things with. Could you explain maybe how that fits into hard money?
Well, if you price your AI tokens in sats, I bet you they will go down in price over time, if you zoom out long enough. I mean, this is not, Bitcoin is still super volatile, and this is like how I envision it to play out over 1,000 years maybe, or like maybe the experiment fails, there's always that possible scenario. But theoretically, you should think of Bitcoin, like you should try to extrapolate all the thought vectors as far ahead into the future as possible, because then you will make the low time preference decisions. And I think all of these AI tokens, they will eventually be priced in sats, and the sats will become more and more valuable over time. And also, AI tokens will be already in fiat terms cheaper over time, because everything needed to create them gets cheaper over time. But priced in sats, that's just that on steroids. So at some point, AI tokens will virtually be free because of the power of the Satoshi. That's how I see that. More questions? Yes.
Yeah, so just a quick question on choosing which arguments to take seriously and not, which you mentioned just recently.
Yeah.
Sometimes, I think, logically speaking, a person with vested interest can still have a good argument. So there is a distinction there, even though it's tricky, but it can be logically, they can just put their money into the arguments they believe in, or regardless, maybe they're selfish and greedy, they want to profit in the situation, but the argument can still be good. So do you ever encounter those situations, and how do you deal with them?
I'd say every single person has vested interest in something. When I mean, I have vested interest. I want my pod to do well, so if I can stir up a bit of controversy, I mean, that's an incentive playing on me. So we all have our incentives. They come from all sorts of places. I'm not saying you should like dismiss all opinions because someone is invested in something stupid. I'm merely saying that you can probably tell more about a person and his opinions by following the money first, and see, like, is there a vested interest here? Is this person sincere? And it's easier to believe them if they don't have a vested interest in what's the Upton Sinclair quote? It's hard to change someone's mind when his income depends on him not changing it. It's a very good way to see the world, I think. Anita? Yeah, we are incentivized to promote Bitcoin and call Bitcoin the best thing ever. Bitcoin just happens to be the best thing ever. So, yeah. Yes?
Thanks for the talk. There was a slide, inflationers are shitcoiners. So my question is, how do you propose to pay miners once the last block has been mined? Thanks.
Well, they will be paid by fees. And also, miners have other incentives to mine than just more dollars. When the last block is mined, there's only the fees and whatever other use cases a Bitcoin miner might have for mining. And remember, difficulty adjustment works both ways. So we could have fewer miners and still a pretty secure network. And if you want to mine to heat your home, and you might as well mine because you hold Bitcoin and you want them to be secure, like the incentive to mine is increased by, if you own a lot of Bitcoin, or if you act as if you own them, you are incentivized to mine in a sense because you're interested in securing the network. So I think there are plenty enough incentives for people to mine than just the block reward. Like that's and just the block subsidy specifically. That's a very small part of it, especially in the long run. And we already had a whole bunch of halvings, and hash rate is still going up. So I don't see that. You get way less sats now than you did in the first 4 years. Yes, but the price will go up forever. If Bitcoin just keeps working, you have an ever-diminishing supply and at least a theoretical ever-increasing demand over time. So I don't see that as a problem. Only if you're fiat-minded and you think of Bitcoin as just another token do you have this problem. Because you don't see that this is the technology that will make all prices fall forever. I happen to be a believer in that, and that's why I'm in Bitcoin in the first place. Yes?
So the next question that I have is, you mentioned that keeping node running costs low is the most important thing. That's basically what I've been working on for the past several years, to optimize Bitcoin Core to be able to do IBD as quickly as possible. A very simple Raspberry Pi 5, for example, can do an IBD in less than a day.
Great.
It's stated very often that there's a fundamental problem here, and then that we have to fundamentally change Bitcoin because it's money. First of all, Bitcoin is not just money, it's programmable money. Programmable money means that we're still figuring out exactly what this is. You also mentioned that fees don't compensate node operators. And I think there's a fundamental misunderstanding here. The node, the purpose of running a node is not to serve others. You explicitly mentioned that the incentives are very important here.
Yeah.
There's no incentive for someone to, we cannot rely on somebody being selfless. That's not the point of running a node. The point of running a node is that you do the actual check the actual transactions yourself. You already have incentives to do that.
Yeah, okay, good points. This is the reason I don't like the term economic node, because I think validating node is a better term for it. Because if you don't validate your incoming transactions, you have no say in what the network is and all of that, so you don't have any real power. However, Coinbase, for instance, has users, and if they do some shitty things with their powerful node, they risk losing those users. So like, all people in the world are economic nodes, even though less powerful ones. They don't matter as much, maybe. But the economy is, there's no such thing as a circular economy. We're all connected, all human beings. So everyone, the incentives at play are everywhere. And what was the first part about there? About that was about the second part of the question, but you said something else about incentives.
It doesn't matter, I can continue. So you also said that 20% of the nodes run knots.
Yeah,
but but you also mentioned at first that you're not technical, and in this case it will be quite important, I think, to mention that it's basically just a simple Sybil attack. Taking this seriously is the 20% is also a fundamental misunderstanding. Thinking that nodes are meant to vote, that's also not the role of nodes.
I wouldn't call it vote.
So then what does it matter if it's 20%? Everyone can choose. It's a free market of nodes. Everyone can choose which of the nodes satisfies their needs.
But that's what I'm saying. That's all I'm saying.
Then there's no 20%.
Okay. So aren't 20% of the network running nodes then? Why is that
Most
number
likely
wrong?
not, but again, it doesn't matter. Everyone has to choose for themselves. It's not a voting system.
No.
There's no 20% or 80%. Everyone has to decide for themselves which of these has a better reputation.
Yeah, but I wasn't claiming that it was a voting system. I claimed that...
So what does 20% mean then?
I'm only trying to make the point that people are switching node software because they believe...
How do you know that? How do you know that? That's exactly what I mean. This is a Sybil attack. It doesn't mean what you're claiming it means. It doesn't mean that people are switching.
Okay, so you don't think people are switching at all? I know a lot of people personally that have switched. Yeah, so why aren't the core nodes the Sybil attack? That's a very good question. Like my point
that doesn't contradict.
My point is nothing to do with the percentages. It only has to do with if people are not satisfied with the software they're running, they will run other software. That's the only thing I'm claiming.
It's a free market. They should do that.
Yes. So, yeah, good then. Then we're in agreement.
We only have time for one more question.
All right.
Do you think things like mini-scripts, ETV, outball, and these mechanisms that allow Bitcoin to be more programmable and have spending conditions, do you think that makes Bitcoin better money, or do you think the risk of that adding complexity and potentially black swanning or creating some type of risk outweighs the benefit of making it better money?
Very good question. I think it's a double-sided sword, or double-edged sword is the term, right? So if all of that is used for making, sats more money-y, or if it's used to make Bitcoin better money, then it's all good. If it's used for other things than making sats better money, then it's not good. So adding complexity is not necessarily good or bad. Everything's a trade-off. So what I want you to do is keep this question, does this make Bitcoin better money, in the back of your minds when developing these things and when deciding on what path to take. So, thank you.
welcome back to lunch. From lunch, we're running a little bit late, but we're going to go ahead and get started. This next speaker, I'm very excited who's able to join us. He's going to be talking about defending Bitcoin as critical infrastructure. So please give a warm welcome to Luc de Wolf. Thank you.
Thanks very much, Nifty. Okay, so defending Bitcoin. The subtitle here is Industrial Grade Cybersecurity for the Monetary Grid. So this talk is going to be about cybersecurity, an area that absolutely there's great knowledge about in the Bitcoin space, but I've never seen anyone frame it quite this way. And I'm going to credentialize myself in a moment, and you might see why. So, okay. First, a little bit about myself, for those of you who don't know me. In the Bitcoin space, I get up to quite many things. I'm one of the organizers of the BTC Hell conference up in Helsinki, Finland. And I've done quite many things with Knut, so if you enjoyed his talk before lunch, I agree with him on many things, but we can have separate conversations about the implications of his monetary thinking. But I produce his podcast, and we co-authored a book together, plenty of other interesting things. But the primary thing that I've been working on for the last 6 months is the book sharing the title of this talk, Defending Bitcoin. But that's only the Bitcoin side of me. I've only been in the Bitcoin space for 4 to 5 years, something like that. But I've been working with industrial systems for a little over a decade, and cybersecurity for about half of that. And so in the industrial control system cybersecurity world, I've credentialized myself. I hold the CISSP and GICSP certifications, Certified Information Systems Security Professional, and Global Industrial Controls Security Professional. Those are just both fancy ways of saying that I proved for the purposes of my employer wanting to give me more money that I have some basis of knowledge in this stuff, but yeah, that's a thing or two if you know what those are. So that's just a little bit about me, cybersecurity in my day job, and Bitcoin. Well, I also do that as my day job, but you know, two day jobs, sort of. Okay. Let's start this thing off. What is cybersecurity? Does anyone have a definition or guess of what is cybersecurity? Anyone? Shout it out. The back? The security of cyber. Very good. A good one. Any others? That's very good. Very good. Sure. Anyone else? Sort of no wrong answers here. But okay, I'll give you my definition. The management of digital risk. So security is all about risk management. And we'll get into the vocabulary of that in just a second here. But digital risk, this is everything since the advent of computers and the internet and all this. Connecting things to the internet has made it vastly easier for someone across the world to try to hack you, for example. Cybersecurity is the management of that risk, and that's a kind of technical term, and maybe a little more dry than you might think, but it's a broad concept and gives us a lot of room to play with here. So I'm going to get into here a little bit of the core vocabulary of cybersecurity so you understand the rest of what I'm talking about. So first of all, a threat, and this was a very good start here. So anything that might come after you, your data, or your systems. This is the cyber attackers which we are defending against, hence defending Bitcoin. A vulnerability, this is technically defined as a weakness. So anything that can be exploited, you can do something bad to it, that's a vulnerability by definition. And theoretically, we also distinguish between a weakness, something that could theoretically be exploited, and a vulnerability is something where the exploit itself has been proven. A control, that's a defense that you put in place to reduce a risk. And reducing risk, the formula at the bottom here, risk equals likelihood times impact. This means the chance of something to happen, that's likelihood. And impact is how bad it is if that thing happens. So a high likelihood event is that you get your password leaked in a hack, something like that. A low likelihood event is that an asteroid drops on all of us right now, and that would be very high impact. But you can't necessarily control against that last thing, where you can watch that movie where everyone was running around in a panic and never actually did anything about it. But anyway, so controls reduce either the likelihood or the impact of a risk. That's the point. Make it less likely to happen, or make it less worse if it does happen. So that's the idea. Or both. Sometimes controls can do both. Defense in depth is a concept that's quite important in cybersecurity generally, and this is to have more than one control here. You have a password for every account imaginable, I assume, generally. If you don't even have a password, then it's not really your account, I guess. But another thing you can do is you can add multi-factor authentication on top of that, so that's a second layer of defense. Threat model, exactly what you mentioned up there here. So this is building a view of who might want to attack you and what you're defending and who from. So yeah, threat modeling is quite important in the cybersecurity world. And this brings me to the 3 cybersecurity goals. In other words, the CIA triad. Not that CIA, the one that built SHA-256 and is listening to all of us, and et cetera, et cetera. No, just coincidence. Stands for confidentiality, integrity, and availability. So everything in cybersecurity is pretty much attempting to defend against one of these things. Confidentiality is making sure that your secrets stay safe. That's your passwords, that's your medical information, that's any data that you don't want out there for everyone in the world to see. Integrity is making sure that nothing is tampered with. So if you get an account that gets hacked, right, the integrity has been tampered with if they start to use it to scam people or, steal your money or something like this. Stealing your money would be an integrity attack, all this stuff. Confidentiality and integrity tend to go hand in hand a little bit. You get one, you kind of get the other in many cases. Availability is the third pillar of cybersecurity, and this is one that might be a little less commonly known or understood. It's making sure that the system is there when you need it. So if you know about a DDoS, that DDoS a website and keep it from being able to be loaded or something like this, or a service, that's an attack against availability. And taking down critical systems is a big part of what attackers might be going for, and it's a different goal than confidentiality or integrity. So that brings us to what I think is interesting part of the talk here, critical infrastructure. So what is critical infrastructure? Well, it's everything that keeps the societies we have today going smoothly. Everything needs to work. Energy, water, electricity, healthcare, the financial system. There are usually every country makes their own definition. The United States has one that has a list of 16 critical infrastructure sectors. Payments is one of them, payment infrastructure, and by that they tend to mean Visa and MasterCard, but also the bank settlement systems. Obviously, Bitcoin falls under that particular category. But it's pretty much everything that if one of these were to go down, you would feel it. Food infrastructure, if there's no water in the taps, that's a big deal, right? So this is critical infrastructure. And powering most critical infrastructure in the world is a particular class of computer and computing technology that's referred to as OT, which is defined as essentially the opposite of IT, information technology. Operational technology is stuff that does things to the real world. That's the basic definition there. And they're purpose-built systems that run these sectors, the oil and gas pipelines, the electrical grid, factories, they all run off this operational technology. And the thing about these systems is that for the longest time, ever since factories and these control systems were developed, they were never connected to the internet. They just lived in a factory somewhere, and some guy who knows how to operate it would be the one guy who fixes it and everything. But now everything's getting connected to the internet, and that brings up a whole slew of issues. I'll get into how this relates to Bitcoin in just a moment here, but the other thing that you see on the right is something called the Purdue model. And this is an architecture that I know we had some Bitcoin layers up here earlier, so those familiar with kind of this layering model, it differentiates the systems in a operational environment into various layers. So supervisory control, then lower level controllers that do various operations, and then finally the physical process, the stuff that actually, say, opens a valve in a pipeline or keeps the electricity grid going. This is important because there's supposed to be a boundary between what we consider kind of the IT infrastructure and the OT, the critical infrastructure underneath it. And again, we'll get back to how that relates to Bitcoin in a moment. But I'll call back to here this CIA triad here. These critical infrastructure sectors, their primary goal is keeping everything running. Keep the system running. That's the number one priority. So availability is the pillar of the CIA triad that is considered the most important for critical infrastructure sectors. The lights have to stay on. That's the key point here. So there's a way of thinking about cybersecurity from these perspectives, and this is a cybersecurity framework called ISAI-EC 62443. They picked a lovely number that's super easy to remember. But it's a standard for industrial cybersecurity. And to break things down a little bit into maybe something that's comprehensible, makes some sense, they define 7 categories of controls that each do a particular job. So we have authentication. That is the user who they say they are. That's more technically like your identity, as opposed to your password, which is authorization. What are they allowed to do? This is the permissions that getting authenticated lets you do. Integrity, this is verbatim from that CIA triad. Has anything been tampered with? Cryptography and encryption both fall under here. Sorry, I really want to be more specific for this audience. Cryptography is the integrity aspect, and confidentiality. Encryption handles confidentiality. So yeah, keeping secret information secret. And integrity is proving that things haven't been tampered with things like signatures. Segmentation is an interesting one, and this is again something that has a particular OT, industrial control systems flavor. Are zones separated and who controls the flows between them? And this again has some parallels with the way Bitcoin's node infrastructure operates here. Then there's response. What happens? Can you detect if something goes wrong, and what happens if something goes wrong? And at availability. Will the system be there when you need it? So these 7 things, there are whole categories of controls. There's a massive library, massive set of standards that is hundreds of pages long. That is this IEC 62443. But it all boils down to these 7 requirements. Okay, so the next concept, security levels. This is about understanding what you're protecting and then putting in a commensurate amount of control on that. And 62443 defines 4 security levels as security level 1, 2, 3, and 4. And basically, for the purposes of understanding what this is, they define everything at the SL1 as protecting against essentially casual issues. Literally browsing a website and downloading some kind of malicious package or something like that. Really basic stuff. Having a password is under that particular category there. Going a little bit further, that's SL2. The attackers are getting more and more sophisticated. SL3 and SL4, these are advanced controls. I've only seen them actually be required for things like nuclear submarines or military infrastructure. Nuclear, again, being a popular one there. For the purposes of thinking about this with Bitcoin, I simplify this a little bit into stuff you should start here, right? The controls that you should implement right away. Going further, things to build your portfolio up there. And then finally, the SL3, SL4, I kind of just abstract into things that are advanced. And if you have big stack and want to protect it, something like this. So, okay, this has been a lot of me talking about cybersecurity. Now, Here's my thesis point. Bitcoin is critical infrastructure and should be treated exactly the same way. So hundreds of millions of holders, right? Well, I mean, we're all here. I'm preaching to the choir on this one. Settlement 24/7, right? That's parallel to needing everything, the uptime to be constant, right? Continuously operating since 2013. We all know about the inflation bug back then, but after that, continuous operation. Mining is an interesting case. Mining is 100% an industrial operation in the physical sense. ASICs have a physical footprint, and they're connected to electrical grids or off-grid, connecting to other applications. They're absolutely a part of the critical infrastructure space. And then the distributed verification without central control. This one is fantastic. This has a lot of parallels to that. There are massive control systems all over the world that collect and bring data all together into one place and always have a central controller. Bitcoin is different, right? There's no central controller. So this is the big problem. You have to do Bitcoin security a different way. So that's what I'm putting forward here. Okay. In the framework here, so you'll see some references to these chapter numbers here. This is all from the book I've just written. It's going to be out at BTC Prague, but you can take a look at the website right now. But basically, I've categorized a set of threats to Bitcoin and organized them into 3 layers. First of all is the things to the individual, to your individual Bitcoin. And this should be the stuff that everyone in this room is pretty familiar with. But I start with the threats of leaving your coins on an exchange, exchange failures, things like this. This should be familiar to everyone. Securing your Bitcoin, this is a massive chapter, self-custody, all this stuff. And I mean, plenty of other people do lots of great work on exactly how to do self-custody. This framework and what I've written about is all about the what. The how is kind of a take it to the next step kind of thing. Privacy and physical security, massively important thing. Your privacy is critical to maintain, for sure. And we've all made the mistake, or many of us have made the mistake of being public as Bitcoiners. So that's something you can't, that's some toothpaste that doesn't go back in the tube kind of thing. I highly recommend that you pick up a copy of Max Hillebrand's book, The Praxeology of Privacy. That chapter in my book is heavily influenced by his, and he's got 500 pages of fantastic content on privacy and how to achieve privacy. So I recommend that. Then we got threats to the network, and this is where things get fun. So I go over node level threats, what can happen when someone is trying to attack your node. Sorry, I went in the wrong order. Mining and 51% attacks here. The importance of decentralizing mining, the risks that can happen if we get above not even 50%, but 40%, 30% of the hash rate. I do cover a couple of hot topics in the community these days, arbitrary data. I've got a chapter on why arbitrary data is effectively an availability attack on Bitcoin. And I make the case for that in the entire rest of the book. So hopefully you see that I've put some thinking into why I think that way. Then there's the whole governance piece that we've been talking about, kind of the Corby-Knotts thing that Knut was talking about earlier. I don't claim to have any solutions, but I also do go over the risks of what happens when there's a chain split. And, well, I'll say writing that chapter convinced me 100% that going into a chain split prematurely isn't a good idea. So that's all I'll say about that. Then there's these external and systemic risks that are kind of going on outside of Bitcoin that we can take into consideration here. The political environment, of course, the regulations that the countries are putting on Bitcoin. The grid itself, the electrical grid network failure. Bitcoin is an internet native network. And without the internet and without the electrical grid, we have some problems. But the whole rest of society has some problems. So at least there's some good news that folks will be working to fix that. But there's always something you can do to fix that. And then finally, I cover the quantum and AI situations here. Originally, it was a quantum chapter, but then it started having some parallels with what's going on with developing AI. And then Nifty, I think you might have some interesting, see some AI coverage there. So, you know. This by no means is a comprehensive list of threats, but I've tried to categorize this into a way that shows that the breadth of what's out there in the Bitcoin space, and come up with not just the threats themselves and cataloging them, but what you can do. So I'll show you what I mean by that. So for every threat, there's a set of controls that you can do with this. I'm just using, in this particular example, the self-custody solution. So what's the risk what are the levels of controls you can put into kind of holding your own Bitcoin? One here, the very basic thing is just withdrawing to self-custody after you buy. Yeah, that eliminates the vast majority of exchange threats. That's pretty good. If you are going to keep your Bitcoin on the exchange, an authenticator app or hardware key multi-factor authentication, that's really important. A strong password manager, password manager, that's another way to reduce the risk. I never say prevent, but reduce the risk of your exchange getting hacked. Going further, locking down your primary email. This is sort of, if you use your one email for everything, you really better make sure the security is good there. Enabling withdrawal address allow lists, so only saying you can withdraw to addresses you know are yours. That prevents someone who gets into your exchange account from withdrawing to their address. Withdrawal delays, those are also good. And then you can go even further to, again, things that many of us might be familiar with here, peer-to-peer trading, Vexel, BISC, RoboSats, you name it. Keeping your KYC, non-KYC stacks separate, good for privacy, right? The thing is, all of this stuff is maybe, for those of us who are familiar with Bitcoin and are really in the community, this might all be familiar and we know all about it, but for people who are just getting started or are coming from outside of Bitcoin, this is information you need to know. So just as an example of kind of how everything that we talked about previously in the conversation relates to Bitcoin, so an authentication method, this is using like a hardware key or multi-factor authentication on exchanges. Authorization, what you can do, multi-sig falls under this category. So being able to have multiple signing, multiple keys to sign for your Bitcoin moving, that's not the authorization control. Integrity, you run your own node, you verify the rules of Bitcoin. So that's an integrity control. You are verifying constantly that Bitcoin is doing what it says it's doing. Confidentiality, this is interesting. This is a privacy angle, right? Using coin join, address rotation, things like this keeps your privacy going, right? And this keeps your Bitcoin stack confidential. Segmentation, this is an interesting one. So distributing mining hash rate geographically. Now, that might sound hard to do, but if you have the resources to do it and influence hash rate, right now the biggest place of concentration of hash rate is the US, right? But there's plenty of places all around the world that have the opportunity to take more hash rate in various different ways, and that just decentralizes the network. Response, well, okay, so again, controversial here, but using mechanisms to reject arbitrary data. This would be a response category, something placed in to respond to a perceived attack. Availability, this is stuff that's keeping the Bitcoin network going if we lose connectivity, things like this. So this is satellites, mesh networks, radio broadcasts, keeping your access to the Bitcoin network available in the case where you might lose access to the internet. So it covers the whole spectrum, and there's kind of something in every category, is what I would say. So where I'll kind of leave this off here is that Bitcoin doesn't have like a central organization that says you must defend Bitcoin, right? Every node is run by a node runner volunteer. Every key is held by a person, and to Knut and all this, like even if you have this fancy multi-sig setup for an organization or something, at the end of the day, some guy is the one who knows how to use that key setup and all this. So every key is held by a person or group of people. Every choice adds up. So choosing to defend Bitcoin, protect your Bitcoin, and defend Bitcoin, the network, every choice is important. And so what I say here is that there's always something you can do, always. no matter what the domain of Bitcoin security we're talking about, you can always do something to influence your situation positively. You might think, okay, how can I do something about quantum, for example? Well, if you have the know-how, you can go get involved in one of the bit proposals or do some development on cryptography. But even if you don't kind of have that know-how, you can also just keep up with the latest options, right? What's the current state of addresses, for example? Is it better to hold a SegWit address or a taproot address? At the moment, for quantum, taproot's not it. But for privacy, taproot has some advantages. Something that's not on this slide that I should maybe add to a future iteration of this presentation is that there's always trade-offs. There are always trade-offs. Everything you do in cybersecurity is a trade-off of convenience. If you have a password, right, you have to remember that password. That's a trade-off. That's inconvenient. But not having everyone in the world able to access your account just by typing in your email address is pretty important, pretty helpful. So everything you do in cybersecurity, there's always a trade-off, and it's entirely about risk management. It's entirely about, is it worth it to implement the controls? But it's up to you. That's the point. At the end of the day, implementing Bitcoin security is all about you. You have to implement your personal Bitcoin security. You can influence the security of the network. You can help defend it against external pressures and emerging threats. It's all on you. But the good news is there's always something you can do. And so I'll just leave this off here with, if this has sounded interesting to you, right now you can go to defendingbitcoin.com, and there's a good chunk of stuff already there, and you can read the entire book right now for free if you want. Just what I request is that you write a review after you've done it, preferably on Amazon, because I want this on as many eyeballs as possible. But this will be launching in June at Prague. You'll be able to get copies, but you can see the one copy of the book I brought here. So that's it. This is Defending Bitcoin, Industrial Grade Cybersecurity for the Monetary Grade. Thank you. I feel like I left time for a couple of questions, maybe. Yeah.
A fast question, yes.
Yes.
You mentioned about AI can be a threat. Which kind of threat are you imagining?
Yeah, so there's two at the moment that are in discussion. One is that AI is taking mining resources. And this one is, okay, there is Marathon and some others are starting to move into AI compute instead of Bitcoin mining. But the thing is, those ASICs are still going to exist. Someone is going to want to turn those ASICs on and put their hash power to the network. So free market is going to do its thing. And the difficulty adjustment is going to do its thing. But we still see all-time highs on the hash rate side. So the point of my bringing that up is just to cover that issue, but that one isn't so huge in my opinion. The maybe more tricky one is that cybersecurity itself, cybersecurity development, is being affected by AI, right? Because we all have these LLMs in this. But the attacking side and the defending side has the same access to resources, essentially. So there's turning into a bit of a proof of work thing, actually, that you have one side is trying to commit cyber attacks and using AI as a tool to do that faster. But then you have the side that's putting up defenses. And so whichever side is able to put more compute into their either attack or defense is the one that might get an upper hand in the short term. So there's a proof of work tie in there. And I would just say that anyone who's using AI for development needs to be really careful. Like there's been some supply chain attacks and things like this that have affected people who use AI. So it's a current issue for sure.
Does it change the economics of the security landscape in the sense of before AI you had fuzzings, in the sense of you could have already had adversaries using fuzzings?
Yes, absolutely. Yeah. Well, and this is just the thing. It's increased the availability of these tools, right? It's made it easier for someone to just put compute towards the problem. You still need expertise on how to do stuff. But I mean, there's some crazy security researchers out there who hacked Microsoft like 6 different ways at some hackathon, right? So using AI, but using it expertly. Right, so it's changing things. All I'm saying is to be aware. That's an underlying thing. Nothing nothing right now is like the sky is falling or is going to take Bitcoin down or is going to kill Bitcoin. It's more about vigilance, right? Being aware that something is there doesn't mean that it's drastically increasing, but I mean there could be an issue. A wallet provider could get a supply chain attack that sneaks in there months in advance, and then 8 months later it gets access to everyone's keys somehow. Like this stuff is possible, right? And so putting resources to defend against that is the recommendation. Back to you, Leifji. Yeah, thank you.
Next up, we have a panel with Jos from Blockwise and Marco from Arcade, going to be moderated by Chris. So we're going to take a quick minute to set up. We'll be right back.
Thank you all for coming.
Okay.
All right. Technical difficulties. Yeah, we start. Maybe Jos, introduce yourself.
Yeah, cool. I'm Jos Lezet, CEO, founder of Blockrise, Bitcoin banking platform regulated in the EU.
I'm Marco Argentieri. I go by Tiero. I'm the founder of Arc Labs. We build Bitcoin infrastructure.
And I'm Chris, CEO of Cedor and Bitsurance, where we insure Bitcoin as well as Bitcoiners. And we're here today to talk about Bitcoin-backed loans with our... Let's drop that.
It's like a live podcast, basically. That's
exactly. We prepared. No. So what are the challenges that you currently see in your business? You're a fully MiCA licensed, you have all of the licenses over in the Netherlands, and you provide various services for Bitcoin. And
yeah, I mean, I think that from our perspective, so what we did is we first looked at the technical issues and we built a lot of solutions there, so semi-custodial solution, etc. So the Bitcoin management side of things is very much under control, it's working, and there's a lot of adoption going on there. But where we innovate and where we struggle most is we're issuing very boring traditional bonds. So the traditional market can buy Bitcoin-backed bonds from 100,000 euros, where we provide interest. So I mean, that's a separate product that's working, but now connecting it to the Bitcoin space and having people understand it and basically still educating how to bring this to the market, this is still where so much innovation has to be done and understanding. And I mean, ideally, we wouldn't use a bond structure, but we would use solutions like Arcade. But yeah, so I think that's exactly the tension area where we need to focus on.
Marco, you had an interesting theory earlier about where we want to go and what is in between. Can you expand on what you voiced earlier?
Yeah, no, it's interesting because if you go back in the early days of Bitcoin, Bitcoin was really faster, more accessible, cheaper Western Union. People were really using it for what we can call remittances. And maybe we're also victim of ourselves, say, oh, this is cheaper than Visa, MasterCard, this is going to work. Then we saw, Bitcoin cannot scale, or at least it wasn't really useful. But I think that's only part of the story, the fact that Bitcoin as a technology cannot really accommodate remittances flow. I think the other part of the story is also what we call user experience for the end user. And I think when we think about remittances, cross-border payments, I think there are two parts of the user experience where I think right now stablecoin are winning, which is one is people don't see fluctuation. It's very hard to explain to someone. That's part of user experience. Why this goes up, why this goes down. And the other aspect is people, especially in the West world, they're used to pay and get paid, not to pay fees, which is for us, when we build self-custodial things and self-custodial solution, we always want to monetize, and how you monetize, you charge a fee. And that's really counterintuitive. So not only we're not giving like a good, something that feels stable to the end user, we also like charging him money instead of giving him money. So I think my theory is like, we will reach a point where the macro economy will be in a different shape, where Bitcoin will have its own say, but we need to address this with, I think, with a credit layer, and I think, which is very abstract, is very meta. What does it mean, credit?
Bitcoin is digital credit.
Yes.
Are you quoting Michael Saylor now?
Exactly. But no, I think there is phases, and I think that's why I'm very interesting right now when people, say, okay, I have my Bitcoin, now I want to buy a house. In a way, it's a part of a payment, right? So it doesn't mean to buy a coffee, and like I can use Bitcoin to be capital for that. And I think that will be the bridge to when we will say, okay, how we can then deliver the best payment experience once we have this layer.
But now I'm curious, because you said, quoting Michael Saylor, so what's your view on it?
So I have to like always preface this, like I'm an engineer by trade. I slipped into insurance almost by accident because I was trying to figure out a solution to a problem that all of us Bitcoiners face. How do you protect yourself against like the physical scenarios like in the meat space? Like you can perfectly protect yourself cryptographically. What happens if somebody kicks your door in and threatens you? You will give out your private keys. I need an insurance for that. Nobody was doing it. We started doing that in 2021. Now I'm here. Now I'm surrounded by lawyers and insurance brokers and like finance dudes, and I do not understand half of it. And there's this saying: if you don't understand it, don't invest in it. And that's why I'm very hesitant on the Michael Saylor synthetic derivative Moonmouth. It sounds very exciting, and he seems to know what he's doing, but it is beyond my pay grade, and I'm happy to be educated on it. So I encourage Saylor to experiment, but I'm not fully on board.
I think it's like, so in general, so let's say what Michael Saylor is doing, what the ETFs is doing, I don't per se agree with it as a long-term good proposal for Bitcoin. But I think it's cool what they're doing, as in, I call this like financial engineering, It's like really coming up with new products from scratch and actually making them work and launching them and getting billions in volume is pretty crazy. And then we can take these ideas and rethink from scratch, okay, how would we do this the Bitcoin way? So not in an ETF or a fund structure. And that is what is key, I think.
So you're agreeing, like what Michael Saylor is doing, very TradFi. Everything is custodial. Everything has this ginormous layer of trust, and you're figuring out a way how to do this or how to improve on this in a more semi-custodial or like way.
And this is exactly, I think, the balance we need to find. I mean, we need adoption. We need a TradFi. So if you take Bitcoin as pristine collateral, you want to build fiat layers around it and use that to bridge. So I see it as a bridge until we denominate in Bitcoin.
Exactly.
And therefore, like, so a lot of people shit on regulation. I always joke around, it's like, I'll take the blame and use our license to get access to the market. But regulation is one of the ways to get these products in. I mean, since we have a MiCA license, we can talk with banks and financial institutions, and they're open to buy our bonds, like, and this is what every Bitcoiner needs, because what you said as well is like, we need financial inclusion, you need to be accepted with Bitcoin holdings in order to buy a house without having a super high salary to finance the house. So this is like the sort of arbitrage that we need to fill and be in between.
Yeah, so regulation compliance gets a bad rap, but like any industry, in order to scale and to grow, I believe there are three pillars. It needs to have capital. We have enormous amounts of capital sitting there. It needs regulation, and I believe the other one is risk mitigation, is insurance. Like we also need to fill that. And personally, I see a massive gap in coverage there. Like not everybody needs insurance. But if you look at exchanges, if you look at large holders, it might make sense to get some.
So I've always joked on insurance that it's just marketing. Could you pitch me differently?
So insurance breaks down, it is a bet. So I bet with you that it is unlikely that something happens to you. You hedge against that very unlikely scenario. You want to be made whole. And it is a voluntary contract that we do. And like the terms are agreed upon before. And you take your best practice, your best care to avoid having to rely on that, but it is for those unforeseen circumstances that, in my opinion, it makes sense to have it. Like I've personally had these experiences where like I'm I would say, quite sophisticated in the way I hold my Bitcoin. I have various time decaying, time expanding multi-sigs. I have an inheritance setup. I've tried literally every hardware signer under the sun. I could, for the life of me, not find a solution. What happens if somebody threatens me or my family? Like, what would I do? Like, I can't, like, if I look over at France right now, like, you have, like, every 2.5 days, there is a robbery and extortion with a crypto/Bitcoin background. Like, somebody at the IRS, at, like, the tax authority, leaked financial data of wealthy people, not just Bitcoiners, but generally wealthy people. And, like, there's somebody in the background, and he doesn't get his fingers dirty. He hires some hoodlums off Telegram, sends them to your house, and people present a decoy wallet or smaller sums and try to weasel out. And one brief phone call, then, you know, they figure out, hey, this person must have 250,000 euros worth of crypto, pull some fingernails. And there's nothing that, you know, like, you are fully doxed in the eyes of the state. This information is out there. In our earlier talk, like Luke said, like, or Max just entered with his book, Praxeology. Very good book on how to keep your privacy. Once it's gone, it's very difficult to become private again. And yeah, the world is turning crazier by the day. And to me, again, like, I'm the furthest from the insurance industry, and I found this as the only solution.
But isn't, in a way, regulation also forcing to create this data on a pot, in a way? Like
Exactly, like everywhere you see these like pushes for like governments, like in the Netherlands, like we have these unrealized capital gains that is now requiring you to tell us about your Bitcoin holdings and all the things that you buy. And I don't know if that actually will happen in the future, but maybe you can expand on that. But it is crazy the amount that, like, of your own privacy that you have to give up to be a member of society in Europe.
I'm going crazy over it because literally everyone, oh, you're from the Netherlands, oh, you're the country with the unrealized tax gains. Great. I mean, like my short opinion on it is if it happens, and I was very much against the reality of it happening. I really thought like the tax authority is not technically feasible, but it really seems like it's going to happen. But in the end, it's just keeping the tax system alive, you know, because the high income doesn't pay any taxes. They structure companies around it. Low income doesn't pay any taxes because it's socially protected. So in the end, it's the middle class income that's going to keep paying the taxes. I have to say the conditions are getting better. Like you can have a reconsideration period of 5 years. But anyway, from a data perspective, I agree. It's messed up. And I think that, like, I used to say often that regulation and privacy don't have to bite each other because it's really up to the companies on how they manage data. And for example, like there's some small things on the Blockrise end, and for the longest time we didn't record the social security numbers. Or what is it, personal or tax identification numbers, until MiCAR forced us to do so. So there's practices you can implement in order to prevent it, and we've still have actually proof as you go. So there's proof of reserves, source of funds. I mean that you need to provide from a compliance perspective. But we always say, you know, if you want to bring one BTC to the platform, you know, these are the questions relevant to it. So we never ask for more than that, but we need to keep fighting for that, and we need to keep improving data security because that's indeed the messed up part. And secondly, like once it's out, I mean that's the problem. Like once data is on the street, you will never be able to get rid of it.
Yeah. So like in Germany, full transparency. Once you are a co-owner of a company, like you're doxed. Like everybody can go online and see where you live. It's very, very easy. And
it's pan-European, I think. Almost every country has that.
Great. Thank you. But yeah, so you have to have some, you know, plan B. Again, trying to convince you of insurance, I think it's a good idea to have some. But could I convince you more or less about insurance?
Yeah. No,
those were all things that you already considered, probably.
I mean, even if it was just a marketing pitch, you could convince me already because users are asking for it. But maybe for also the relevance of this panel, what I think more is interesting also towards insurance is like where do the pain points lay, and why is not everyone offering this already today?
I think it's interesting also, especially for loans. You know, like in a normal traditional finance, when you get a Lombard in a bank, or like they will call you on the phone, and maybe you get liquidated, right, on your portfolio. They will call you, hey, you have another something else to give us. So it's interesting in Bitcoin-backed loans, and especially let's say the non-custodial one, if you can define them. I think there is an inherent risk around the liquidation aspect, where I really think insurance can come in that aspect, because like I want to be insured by an Oracle that just go rogue, or Binance tomorrow. If I use it, Binance, they went from 0 one day, so the price went down. So what happens? My collateral gets liquidated. So I think it's interesting to see more beyond just static holding, and especially when you start using it in these products, I think insurance comes as a help for you to mitigate your risk in holding these products or these services in a way.
Yes, I said, like, if there's an oracle, or like in the market condition there's like a blip and suddenly like you get liquidated even though like it should not have happened, like there are credit default swaps, there's insurance against slippage. These things can be offered, need to be offered, and it took an enormous amount of effort on our part at Bitsurance to talk to insurance companies to convince them, hey, Bitcoin is here to stay. Bitcoin is a thing that is not only like it financialized with the ETFs in 2024, but long before that we launched with Bitsurance. And it took so much elbow grease and like meeting with insurance companies to tell them, hey, you need to offer insurance on that, because like you already insure the craziest stuff, like you insure gold bars and fine wines and watches and like Jennifer Lopez, but like why can't we insure Bitcoin? And they're coming around. Like we work with the first insurer called Liberty Mutual. They're the 5th largest insurer, specie insurer in the world. And they have been around for 113 years. Like, you don't have to trust us, you have to trust them. And they are like now working with us to insure more institutions, to go from B2C to B2B, much higher limits. There is our friendly competitors in the United States, AnchorWatch. They try to offer insurance for all of the exchanges and very large holders. They insure up to $100 million US. And when you look at the market as a whole, like that market is entirely underinsured. If you go like with Coinbase and Bitfinex, like the largest exchanges, they have like $1 billion worth of insurance on 400 billion worth of assets that they have under management. They essentially self-insure. They hope nothing goes wrong. And if we study history, there have been like over 300 exchanges that lost funds. And yeah, in that scenario, you are not on the policy.
Yeah, so maybe looking forward, I mean, I think that like a little bit of the key thing we're seeing is we're in a bridging phase, because if there's an ideology of self-custody, then this all looks different. I mean, the exchanges won't have to insurance that much because at least I think that so much more funds can be taken off exchange. Like from a block-wise perspective, we see hundreds of Bitcoins held with people that really don't know what they're doing in exchanges, and they feel like it's safe. Even if it's amicalized, like they cannot verify, it's just a 2FA token away from a withdrawal sometimes. So this is a bridging period that we're looking at, but we need to keep building on both sides. I mean, we need to bridge it because we need adoption, but we also need to look at the native solutions such as Arcade. So maybe to switch the topic a little bit, it's like what is the way forward towards more native adoption there?
Yeah, one interesting aspect is like if you right now, especially if you want to take a loan against your Bitcoin as a collateral, right now you have originator platforms and such Debify, for example. But at the same time, it really feels very bespoke bilateral agreement, right? So you need to find the borrower, the lender with the same expiration date, with the right amount, and the lender cannot go out. So what I'm trying to say, this double confidence of wants is very hard to scale in a way to make it really liquid and really scale to biggest. And in a way, like in a way, if you go look at the banking history, what banks always did was like this sort of pooling, right? They take a lot of deposit for a small depositor, and then they go to biggest borrower, maybe entrepreneur. They need capital for their business. And in a way, like we are missing a native solution, because if you go to other, for example, blockchain ecosystem, you have like half of the rates. And maybe a question also for you is like, why if you go to other blockchain ecosystem, you have half of the rates that Bitcoin loans or Bitcoin-backed loans are there? And very curious to see how, for example, you see how to go there. I think technology maybe is one for sure to attract, native Bitcoin holder that they want to verify where their keys are, maybe a Bitcoin native multisig, a Bitcoin native escrow, right? So we just went live with Hodl Hodl. Hodl Hodl is a platform that does peer-to-peer trading using escrow technology, but they were using on-chain. So for every trade, let's say $100 buying with Revolut, you need to lock a Bitcoin transaction, doing a on-chain transaction, then unlock it out. So it was like very expensive, very slow. So now we went with them, and now we allow them to basically use the same 2 of 3 technology. Very simple, very basic, but at the same time now we can do $5. They can fund it with Lightning. So there are many advantages to that, right, with technology. But I don't think technology is enough. I think also there is a part like how we can make lender to be more comfortable to, to use their balance sheet, normal fiat lenders, to give out loans.
Yeah, so skipping back a little bit, what you said on why other protocols are offering much lower interest rates. Interest is quite a simple mechanism where it's basically a base factor, and then for risk, for liquidity, for terms, you basically increase or decrease the interest. And when you talk about a lot of protocols, in general, I think they're extremely high risk. We've seen this with the Aave recently, of course, and then suddenly the interest rate spikes to 20%. So, and then interestingly, liquidations and everything tend to happen as well. So, finding a very balanced product or proposition is where the challenge lays. And as much as I would love to chip into stablecoins, it's just, I think, infeasible, especially euro denominated. Like 99.8% of all stablecoins are denominated in dollars. So euro stablecoins is not a feasible option with all the smart contract risk and all the other complexity risks there. So yeah, I think you're right. Like we offered in a very 2-layer boring structure where you collateralize your Bitcoin first, and then we just pay out the loan. The good thing is you can verify the ownership, you can do message signing, everything. You can monitor the XPub, to make sure that your Bitcoin collateral remains there. But it's just as a lack of better. Like I would love to have a euro stablecoin that's extremely liquid, that we can buy at less than 6%. So we currently buy euros at 6% from the traditional markets. I would love to buy it at 3%, so we can offer 5% Bitcoin-backed loans. But the infrastructure is just not there. And the regulation isn't there either. We got a full-on MiCA license with indeed as much as we can, full-fledged. And now we're talking to the consumer credit departments of the regulator, and we have to explain what is Bitcoin, because it's a different team, and they really don't know. And so we got a legal opinion on the business, like the corporate account offering of Bitcoin-backed loans. It's exactly the same product, same agreements, everything. They loved it. It is like we take all the risk, liquidation, everything's with us. So the borrower doesn't take it, the lender doesn't take it, we take it, and then we translate it to consumer loans, and it's like, yeah, no. So this is, it just takes time. Good things take time. And I really hope that, for example, the euro stablecoins, that's why I'm pushing you as well for euro stablecoins, because we need them. There's a massive market out there, and we can bridge it to very user-friendly solutions.
But what would be, in your opinion, for example, like a normal person, I want to take a mortgage, buy a house, right? So very normal use case, And you say, well, I have some Bitcoin, I want to do that. Like, what do you think that will be the unlock for this to make it feasible, in your opinion?
Well, this is a lengthy discussion because, first of all, do you want to do it natively, like via Arcade, or do you want to do the traditional way, how we do it? There's a difference there. I think one of the main problems there is that you need to, like we as a financial institution need to put Bitcoin on the balance sheet of the users, title transfers, etc. But the problem is that under Basel III, Bitcoin is a risk-weighted asset of 1,250%, meaning for every Bitcoin euro worth, we need to cover with 1,250% in euros. So that's not feasible right now. And that's why we have to go to private markets. That's why we are very comparable to private debt funds, for example. And that needs to change. But of course, this is an extremely difficult lobby. So fortunately, it's coming from the US. So there was actually, in the what's it called, in the parliament, there was a discussion about this. But it's directly, I think, positioning against banks to have Bitcoin as a less risk-weighted asset. But if that ever happens in future, yes, interest rates will immediately drop to 3-4% because banks can put Bitcoin on the balance sheet and they can provide loans against it. So they can provide us capital, they can buy our bonds much more easily. Until then, I don't think that in Europe the rates, at least on the traditional side, is going to drop below the, let's say, 4 or 5%. On the buying side. So on the selling side, 6% I think is going to be the minimum, unfortunately.
Yeah, that's also one of the reasons why we cannot denominate our insurance in Bitcoin, because in Europe, you're not allowed as an insurance company to have Bitcoin on the balance count against the risk that you're taking on, which okay, I get it, Bitcoin is new, but surprisingly, you can also don't do that with gold. Like insurance companies cannot hoard gold, even though it has been a proven store of value. Like the conspiracy-minded person in me thinks like the reason there is somebody needs to buy T-bills, somebody needs to buy treasury bonds, otherwise, there is no market for that. And that's how they force insurance companies to buy that instead of gold or Bitcoin. There are institutions or there are nations out there where you can have Bitcoin like full balance sheets, like in Bermuda, like insurance companies can hold Bitcoin, and the game theory hopefully plays out eventually that we will, see that market advantage and then also convince the European regulators, hey, don't be the last to come onto Bitcoin.
Maybe a more meta question I was thinking, because right now when we talk about loans, Bitcoin-backed loans, we assume there is on the other side either fiat or a stable coin, which makes sense, and then you have a fiat rate. But there will be a future, let's say, okay, we reach hyper-Bitcoinization, like, will credit still be a thing? I will borrow Bitcoin to do things? Like, it will just be, like, I will put Bitcoin to borrow other Bitcoin? Just more meta question, I don't know if...
Yeah, I think it's similar to the idea that we have to provide credit cards based on your Bitcoin holdings, so not collateralizing Bitcoin, but literally, so you keep the Bitcoin within the platform, so it's like proven that it's yours, and based on that, assign you a credit score. Basically, it's like in Europe, we don't have standardized credit scores, but with consumer credit loans, we can, or credit institution license, we can give out creditability to clients. So this is a little bit, I think, the same path, right? So that will also be a potential way to give out mortgages without having to collateralize it. Yeah, I mean, I hope so. But it's like, unfortunately, a long way ahead. But that's fine, because first we need to get adoption up, way up. The incentives need to align. There needs to be a push for this. And if a lot more people start taking Bitcoin in as a pristine collateral, then there's more incentive to build these kind of solutions as well.
How do we get adoption up? How do we get adoption up? What is the next step?
Well, I mean, I'm super biased, but I think that custody still sucks in most cases. So again, the amount of people that have Bitcoin on exchanges or on single sig wallets is ridiculous. Like recently, I was at Ledger in Paris in the headquarters, and they hold like 22% of all Bitcoin in circulation on Ledger wallets.
Yeah. How do they know?
Well,
sorry, I know, it's a rhetoric question.
Yeah, I mean, unfortunately they know, and maybe it's even more. I mean, but
yeah, I mean, I was very surprised when I did research for Bitsurance, like what kind of hardware wallets do you want to insure? And I'm personally a little bit biased. Like I like the Bitbox, I like Spectre, I like Cold Cards. I like everybody probably had a Ledger back in the day, and I've stopped using them. I don't know, not that great software. The hardware is still great, but like. Looking at the sales numbers, I was like shocked. Like there is only around 12 to 13 million hardware wallets sold ever. Like notwithstanding probably some DIY things like a Crux or Seed Signer or Spectre, like where you can buy off-the-shelf components, but like ready-made hardware signers, only like 12 or 13 millions. Juxtapose that to like 400 million crypto exposed people, like most of them are with Coinbase, most of them are with Bitfinex, and like I myself account for like at least 20 of those devices. So like you can whittle down that number. So yeah, I think it's exciting when I see like products like the BitKey who like takes on an entirely new approach. Probably not for the cypherpunk minded, not for the person that wants to have like an autonomous key that can like there's no vendor lock-in or something, but like this needs to massively improve. The more people will use more secure setups, multi-sig, and take it off in exchange. But yeah.
But indeed, like from a Bitcoin community perspective, it's really frowned upon. And I mean, I got so much shit on our solution. Even though it's like, I see it as an intermediary phase. It's like here to help adoption without compromising on centralizing funds and keeping omnibus accounts and introducing risks. So this is what we need. And then if like once you're there, once you're ready to buy a hardware device, to set up multi-sig, etc., then you do you. I mean, but we need to facilitate this first step, because imagine what happens if, like, Coinbase has what, over 2 million Bitcoin supposedly held in custody. Imagine that we can put half of those in self-custody wallets. that would, like, the network would change. The
it
narrative
would solve all of our problems. Like, we would price out all the spam. We would have an active fee market, and then we would have better price discovery. Like, you cannot have paper Bitcoins, but if there's like one ginormous holder, you never know. But
exactly. And I mean, it would, like, the bear market there, everything would change. So I see this, and this is also my talk later today, is like, I see all these cool developments, and I really love it from a technology perspective, from an engineering perspective. But let's first get 10% of the global population to use, to allocate some Bitcoin in a pure way, and from there we can move forward.
we have like 2 minutes left for questions.
Easy.
All questions have been answered. Then we will continue to rant on.
No, maybe most exciting. Like, what is realistically going to happen this year that you're most excited for from BitSurance and Arcade, maybe?
Yeah, I'm really excited that we have a great team at BitSurance and with our first insurer, Liberty Mutual. Like, their chief underwriter now, like, he's a fully fledged Bitcoiner. Like, he risen the ranks in that company, and he's excited to build more products with Bitcoin, not just like small time, but big products. And yeah, we're cooking.
So expanding to more countries and
more countries, higher limits. Yeah, the whole thing.
Yeah, no, on our side, we're very excited on the pipeline of new primitives we want to bring to, or re-bring back to Bitcoin from the early days. Escrow already mentioned, lending infrastructure done in a way where it can improve the current origination platform, or even just like making sure you don't need to just choose one side of technology, but just trying to make sure to give all the possible tooling to wallet to swap in and out, Lightning on chain, other ecosystem without leaving Bitcoin keys or just choosing another technology. So try to reshore, as I say, reshore use cases that were Bitcoin use cases from the early days. They left in a way.
Yeah, maybe on my side. So we, I mean, we have the setup there, and I mean, multi-sig and flexibility is coming. But I think the biggest thing that we can have a big play with this year is bank accounts. So we offer the full bank account since 3 weeks now, and rolling that out across Europe and really making people able to switch their main bank account to our platform, having Bitcoin-friendly bank accounts, and then with the whole Bitcoin infra there as well. Very excited, and it's like literally rolling out every week with new features. So good times ahead. Well, thank you guys for time and input, and
thank you.
Thank you.
Hello, yeah. So in today's talk, I want to demonstrate how closed systems foster closed societies and how freedom tech and open society correlate and are basically depending on each other. My talk spans lived experiences in Zimbabwe, the latest freedom tech developments and their intersection as tools for human agency. The term free software, as many of you know, I assume, was coined by Richard Stallman in 1983 already. And what most of us, including me, didn't know is that Christine Peterson was the one who coined the term open source at the end of the last century, because they thought there is a distinguishing characteristic needed so that people don't understand free software as in free beer, but in free speech. The term open society was coined by French philosopher Henri Bergson in 1932, and it was redefined by Austrian philosopher Karl Popper in his book The Open Society and Its Enemies that he wrote after the Second World War. And the second philosopher who had to emigrate from Austria and Germany was Hannah Arendt, and she also worked a lot along the collapse of liberal democracies and the rise of totalitarianism. And an open society protects individual freedoms and minority rights, limits state power, and allows institutions and leaders to be publicly questioned and replaced. It tolerates diverse viewpoints and lifestyles and creates a shared sense of meaning. It's a society committed to critical thinking, democratic institutions, and the rejection of authoritarian ideologies. When I started learning about Bitcoin in 2017, I was interested in how it can elevate people out of exploitative systems. And one of the things I was hearing back then is Bitcoin's supply is scarce, it cannot be inflated, and in that sense, it's an exit or an option for people living in countries with hyperinflation like Venezuela and Zimbabwe. But no one who was talking about this actually was ever in Zimbabwe. So I had the option to go, and I wanted to learn and understand how the monetary system really is failing people in these countries, and Zimbabwe is the poster child, basically. So in 2020, I went the first time, and in 2022, when I came back, I saw this man on the side of the road carrying a plastic bag full of banknotes. And he was definitely not a rich person in that sense. And so in 22, the inflationary spiral was back, but not as extreme as in the 2000s, where we all have heard about the hyperinflation in Zimbabwe. Myself, growing up in a country, in Austria, that's a so-called developed nation, we have inflation targets. And the inflation always was something like 2 to 3%. And I didn't know anything, I didn't learn it in school, as most of us did not. That 2 to 3% inflation is not normal, or it's just the thing. Yes, it's the thing for the fiat system. But over the time, of course, it also compounds. And so I saw through Bitcoin and my learnings in Zimbabwe how a closed system controlled by the few can be abused, and how it depends on the decisions of people who may or may not have information, or the information or the will to make decisions that benefit everyone. I have no proof, but I'm very, very sure that Satoshi Nakamoto knew about these banknotes and about hyperinflation in Zimbabwe. While Nakamoto referred the global financial crisis in the Bitcoin Genesis block, the Zimbabwean financial crisis was homemade. It started with aggressive land reforms in the year 2000 that destroyed the agricultural productivity, drove many farmers and skilled workers out of the country, and that resulted in a huge brain drain and caused a drastic reduction of the local manufacturing industry. Back then, in Robert Mugabe's time, money was printed to pay off war veterans, to pay for the war in the DRC, to secure mineral wealth for his political allies. That led to governmental price controls, which caused supply collapses. Producers could not sell their goods for the regulated prices as they didn't cover their costs. And in 2009, there was a complete loss of fiscal discipline and central bank independence, if there is anything like central bank independence. So the global financial crisis was caused by recklessness, speculation, and the fragility of a system that collapsed like a house of cards. In Zimbabwe, it was and has been and is still corruption and personal enrichment and the will to stay in power. But both crises were made possible by the same underlying structure, an intransparent financial system which is controlled by a small circle of people. Zimbabwe is a very wealthy country. It's wealthy in gold, diamonds, rare earths. The standard of living could be much higher for every Zimbabwean with free access to education, a functioning health system, pensions. But instead, a minority has been extracting value from the country and its people since independence in 1980. And it demonstrates how the fiat system, which creates money through the issuance of bank credit backed by no real assets, can be abused by those in power. Critics then, of course, will say Bitcoin is not backed by real assets either. But we know they are wrong. Bitcoin is backed by computational proof of work, by investments in electricity and computing infrastructure. The price of Bitcoin is found on open markets, on decentralized markets worldwide, 24 hours a day. The trading books are public. And the peer-to-peer market, which is existing on the streets in Zimbabwe to exchange US dollars to Zimbabwe dollar, finds its price also on the real market. So that's a similarity with the existing system and the exit of it for the people in Zimbabwe. When I visited the first time, there were separate tills. One was for US dollar and the other was for Zimbabwean dollars. Every day you go to the shops and you check what the exchange rate is. And depending on the daily exchange rate, you decide, okay, today I'm paying in US dollars or I'm paying with mobile money because it gives me a better rate in the end. So it's a permanent hustle in a way. Then there are no coins around. So for US, not for Zimbabwe dollar or for US dollar. So when you don't find an exact amount at the counter, you will receive either some sweets, chewing gum, or things like that. Or some stores also have their own vouchers, but the problem with these vouchers is, first, you forget them at home, and second, they have an expiry date. So you always lose money in a way. So between 2009 and 2019, they didn't really have their own currency, but the US dollar, the South African rand, the Botswana pula, as well as the euro and the pound were legal tender. And in that time, the prices stabilized, and there was even some slow growth in the economy. And what's also very interesting, I mean, what you don't think about this when you don't live there, at least for a while. There's always a shortage of US dollar cash because everyone wants it. So the quality of the banknotes show themselves how high they are in demand. Because if you find a new or prettier US dollar note, you don't want to spend it. You want to always, like we say, spend the bad money, keep the good money. So I once had $30 of value, and they were all torn notes. So I didn't know what to do. I asked our gardener, and he said, okay, I'll take it for you, but you only get $20 US. And I said, okay, it's better than nothing, because street vendors don't accept it. And then I found out there's actually a real market with torn notes. In 2019, the Zimbabwean dollar was reintroduced with a promised exchange rate of 1-to-1 Zimbabwe dollar to US dollar. A friend of mine experienced firsthand what that means. That means you have a US dollar bank account on a Zimbabwean bank, and from one day to the other, your $10,000 are 10,000 Zimbabwe dollars. So basically, it's really stealing. They steal from you. And they even had a marketing campaign promising the exchange rate will stay the same. Of course, no one believed it. And hyperinflation, we hear that, but you can't feel what it really means. So maybe with this example, with a loaf of bread, I can demonstrate what it means. So in 2020, when I came the first time, a loaf of bread costs $1 US. It still costs $1 US, but it's smaller now. And as you can see, in 2020, the exchange rate was 1-to-28. The next time, where I took the picture in 2022, it was 1-to-200. Only 1 year later, 1 to 4,000. And then it exploded 2 years ago. It was 12,000, and only 3 months later, 35,000. So 35,000 Zimbabwe dollar for a loaf of bread. And why is this important? Because not everyone earns in US dollar. Most people don't earn in US dollar. They earn in the worthless Zimbabwe dollar, and then you have a big, big problem. And what did the government do to solve this problem? They just invented a new currency, called it ZiG, Zimbabwe Gold, and say it's backed by gold. I mean, you could believe it because Zimbabwe has really a lot of gold, but people didn't believe it anymore, and actually not even the government believed themselves, because if you want to issue a new passport, if you need a driver's license, if you need a license for your car, the government wants US dollars, not Zimbabwe gold. But still, also the Zimbabwe biggest retailers, the formal shops, they are forced to use the official exchange rate, the bank rate, which is much worse than the street rate. And so people are not visiting these shops anymore. And in April, when I was there, they were always empty. But still, the government tries to enforce the use of their currency, but of course just for the people, not for themselves. So closed systems, like the fiat monetary system that allow the indefinite creation of monetary units by human decision, cannot discover the real value of money. It's similar to the exchange rate controls in Zimbabwe, where the reserve banks decides on the value of a banknote while the street markets finds the real rate. Authorities then call that the black market rate in an attempt to make it sound criminal when it's actually the real value of money. And when then people are seeking an exit by using US dollars, the government exerts power by arresting money exchangers, bulldozing the informal tuck shops, and turning off the internet to shut up demonstrations. And not a surprise, the same happened with the ZiG, or is happening with the Zimbabwe gold. First, when they introduced it, there were no banknotes in circulation. It was only used for mobile money. And they decided, nobody knew why, at the beginning, 1 ZiG is, like 1 US dollar is 13 ZiG. Nobody knew why. And also, there was never an independent audit of the gold backing. So, and interestingly enough, the same time that the value of the ZiG deteriorated, the gold price went up 24%. So how can it be backed by gold? In April this year, new banknotes were introduced, denominations of 10, 20, and 50 ZiG. They also produced 100 and 200 ZiG, but they said they will be introduced gradually, guided by transactional demand and prevailing monetary conditions, which is a nice way to say when the value of the ZiG has deteriorated so much that we need the other denominations, we will release them. And a couple of days before they issued the new ZiG notes, they made a marketing campaign, and your US dollar is very safe, which of course signaled to everyone, oh my God, will they ban the US dollar again? And at that time, I was in the eastern part of Zimbabwe on the countryside in rural areas, and I asked them, do you use the ZiG? Have you seen new banknotes? And they said no, and we don't use it. So, and the day that they introduced it, the exchange rate went from 28 to 40. And people simply reject the currency. They say it's useless. And of course, they're right. And it's also easy then to say, oh, the first time in 30 years, our inflation falls to single digits. It's very easy when you have a currency that no one is using, and you are manipulating everyone and everything. So what are the effects on society? Sadly, they are very, very bad. Social norms are basically falling apart. There's one example I want to give of the practical problems that people have. I spoke with the Zimbabweans who I learned about a practice of the powerful with the money printer. They enforce that school fees, for instance, have to be paid in the local currency. Then they issue more local currency. Then they engage runners who then drive to the rural areas and sell their worthless new banknotes to the people who give them US dollars in exchange. So it's really an elaborate scheme to steal from your own population. And everyone knows about that. And the devastating effect is that 60% of the population live under $3 per day. They have no health insurance, no rights whatsoever. 95% are hustling, so they don't have a formal job. Every day they try to find enough money to survive. Driver's licenses can be bought. Almost everything can be accelerated with a bribe. So society really runs on corruption and theft. And since there's no attempt at a functioning rule of law and no freedom of speech, people are jailed simply for the slightest criticism of the government, and individuals across all classes live in a permanent survival mode. And it shows in the individual behavior. There's reckless driving. Zimbabwe has one of the highest death rates in traffic. A run to all kind of churches and pastors in hope of a better life. Children, sadly, of course, mostly girls, are being taken out of school because the school fees can't be paid. And there's this constant sense of that your own survival comes before anyone else's. So Bitcoin is emancipation from financial patriarchy. But Bitcoin is not only that. It's the basis for new tech, and one of that is Nostr. It's also an open protocol. It's being built with the same principles in mind, like Bitcoin, being censorship resistant, permissionless, and it gives humans agency. And agency over, you own your identity, you own your data. And then a lot of apps are being built on Nostr at the moment. For instance, BitChat is a peer-to-peer messaging app that works via Bluetooth. So when enough people download it, they have an opportunity to communicate, although there are internet shutdowns. Divine is a short video platform where you own your own content, and it's human-centered, so there is no AI slop. And then you have a lot of different other apps being built, not only social media apps, but also VPNs and other technology. And human agency is defined as the capacity of individuals to act independently, make intentional choices, and exert control over their own functioning and the course of events. In today's world, with a default on surveillance, extraction, and dependency through software, finance, and corporations, human agency is compressed and depending on compliance. This is not progress. Progress is an increase in human agency. And in a world where software mediates every dimension of social life, the question of who controls software is inseparable from the question of who holds power in society. Likewise, who controls money controls power. If we put these things together, you can see why open money and open software are subsumed as freedom tech, because they shift structural power to the user instead of away from them. And the fact that most people, sadly, do not self-custody their Bitcoin, or rather go for convenience instead of privacy and use Telegram instead of Signal or Simple X, does not lessen the importance of freedom tech creating conditions for agency. The freedoms still matter, even when most individuals do not personally use them. They are a shield for others who might need the protection more than us or the majority of people. So human agency and open society go hand in hand. they depend on open systems that anyone can inspect, question, and hold accountable. When the rules that govern money, communication, and information are transparent and open, power stays distributed and no single authority can manipulate them in secret. Authoritarian systems, by contrast, rely on opacity. Closed rules, hidden code, and proprietary protocols that concentrate control and make accountability impossible. Open systems are the basis for open societies. The architecture of a society's tools is never neutral. So build open systems, closed systems serve closed power. Let's build something better together. Thank you. Any questions?
For the nice talk. It was very insightful, and I think it's extremely cool that you had some first-hand experience in this hyperinflation in Zimbabwe. I've been wondering, since people over there are quite familiar with the dollar, do you think they will soon enough migrate to stable coins, maybe before moving to Bitcoin? Because stable coins exploded since last year, and I think there's a bigger market, and maybe they don't need any new, let's say, knowledge on how Bitcoin works and which are its characteristics.
So yeah, I can tell you the USDT has already exploded in Zimbabwe, and yes, it's true that more people use USDT than Bitcoin. Because yes, exactly, they know about the value of the US dollar, despite the fact that it's also inflationary and loses value. But still, for them, they put trust in the US dollar, not in their own currency. And the problem is that for Bitcoin, you must have a very special use case. And that use case comes when the US dollar, USDT is being censored or your account is blocked. So then they will switch to Bitcoin, I assume, and there are people who are using Bitcoin. But it's similar to here, mostly to hold the money and to speculate on the increase. So I always say they save it. Because a lot of people most people can't even afford to use Bitcoin or save money. And so, yes, it's true, but I still believe that Bitcoin and open technology, especially in authoritarian countries, is the most important use case. It's much more important than here, to be honest. Yeah? So people need it the most there, and therefore I think it's important also to distinguish Bitcoin, the technology, from Bitcoin, the scam. Because everyone knows the word Bitcoin, but everyone asks me, is it not a scam? Is it real? Is it legal? So there are so many questions. And of course, most of Zimbabweans have been ripped off for many, many years now. And so, of course, they don't trust the technology of the white man. Yeah? So they didn't trust the internet. They don't trust Bitcoin. USDT, I'm sure they don't know that it's relying on intermediaries or whatever, but it says US dollar, and it works. Yeah. And it's easier to use because you know the fees and everything, so yeah.
Thank you very much, Anita. Great as always. Unfortunately, in Europe, we are also seeing government going more in direction of the authoritarian, totalitarian panopticon that you're presenting. Is there any action at governmental level happening to try to educate the decision maker on all the bad things of money?
There are a few people who try to do that on the European level, but in Austria, for instance, I don't know, and I'm one of the few speakers speaking about human rights and Bitcoin, except for the Human Rights Foundation. I don't know if anyone else does it. So that's the same here, and I believe that's exactly why I say these times are coming for us too. So we will need it more, and so it would be good if everyone would learn about it. But how shall I say? There really needs to be a shift in the narrative around Bitcoin. And having Michael Saylor talk the 5th time as a headliner in Prague is not really a good way to show what Bitcoin actually can do for us and for democracy and for open societies. Yeah. So, yeah.
So when you use the word freedom, it feels to me like you are describing financial freedom. And I would define it as the freedom to transact and freedom from fiat debasement. I don't know if you agree with that. So, do you think that is do you think that alone by itself can achieve what you describe as open society, or do you? Because for me, I think it is a necessary but not sufficient condition for open society. You also need economic freedom, i.e., you need property rights to achieve that. So,
of course,
would you agree?
I absolutely agree. But Bitcoin is a tool in this toolkit. So, and Bitcoin allows freedom of speech in that sense that you can donate money to your political party or the issue that you want to support that maybe is not seen as a good thing from the government, and that censors you and shuts down your bank account. So Bitcoin is an opportunity to use money when you are basically a minority or, a political, an opposition maker and things like that. So yes, I agree, it's part of many things.
My question is on the US stablecoins and Bitcoin. So there is, I think, two trends that are relevant. One is that there is now mass global adoption of US dollar stablecoins. And on the other hand, that drives the demand for US bonds, which keeps the current fiat machine going. And this means that, in the West it stays almost like a status quo, but everybody kind of gets a slightly better fiat. Like the Zimbabweans are going to have better money, but not like Bitcoin. And then on the other hand, even in authoritarian countries that openly ban Bitcoin or just don't want to use it on the population level, we have leaders and their families and their cronies who actually like Bitcoin.
Sure.
And this brings us, these two trends, like I'm wondering, how do you see this playing out on the macro level? Meaning, will they at some point maybe go towards strategic reserves in these countries? And also, like in Europe, it's totally different, where we have governments that are kind of trying to slow the adoption down as much, but the leaders are probably not flexible enough to do it themselves, like to hoard Bitcoin themselves. So what do you think?
Of course they are using it, and of course they know about it. And like in Zimbabwe, for instance, the central bank or the government has basically issued a ban for financial institutions to be in contact with any of the cryptocurrencies. But of course they use it for themselves. I mean, they hoard US dollar packages at home, so they will use Bitcoin too. So one of the guys I showed you, the money exchanger that has been arrested, he's actually, I talked with him once before I knew who he is, because he's the son of a minister. And so I didn't talk with him anymore. And so he will, of course, supply his people, the party and the government with Bitcoin. Yeah, definitely. So, yeah.
Okay, yeah, very last question.
Yes, I'm gonna be quick. I actually wonder, so this is going to be a naive question.
It's fine.
How is the US reacting to this situation? Because they hold quite some power since their population is using US dollars, right?
But that's great for the US dollar. The more people use it, the better it's for them.
Are they doing anything, putting money somewhere, infrastructure? Or,
no, in Zimbabwe there's not much going on. I mean, China is very big in Africa, and I think China is already owned Africa is already owned by China in many countries. For instance, Ethiopia has a lot of Bitcoin mining, but it's all Chinese. So nothing stays in Ethiopia. There is a strategy paper from the Bitcoin Policy Institute in the US, who want to do more mining in Africa, and they sell it as, we are better than the Chinese because we at least give you US dollars and we give people a little bit of work, which the Chinese don't do. So we are better than them, and we have our own strategy to grow the empire into Africa. So everything repeats itself. Yeah. So, and that's why I think it's so important that the work we have done the last 5-6 years to support local initiatives, to educate their communities, to build their own educational platforms and stuff, to educate people about Bitcoin and financial education in principle is so important. So because I feel Bitcoin is a tool for empowerment, and I don't. For me, it's awful to see the US coming in again. You know, so they are the hegemon in every way because all financial regulations that are done by the US are being applied everywhere else, and so yeah, so it's not good, no. But at least we have hope because there is Bitcoin and you can use it when you know about it. Yeah. Okay, thank you.
Thank you.
That was great. It's always interesting to hear about how currency and economics, I think, works in contexts where it's used, I think, as a tool for power and distraction. So that was really cool to hear about Anita's experiences in Zimbabwe. We've got one more talk before our coffee break. I'm very excited to have Thomas here, I believe, CEO of Relay, one of the fastest growing exchanges in the European exchange, here to talk to us about what it's like being a middleman for Bitcoin in 2026. So without further ado, here's Thomas. Thank you.
All right. There we go. All right, can you hear me in the back? Thank you. So, Bitcoin was supposed to kill the middleman. Satoshi's white paper even opens with the promise to remove the trusted intermediaries from the picture. And yet here I am, 17 years later, running such an intermediary, posting record profit, record revenue year after year, growing 3-digit percentage rate on average, while being regulated, so fully regulated and with audited financial statement company. So either Satoshi was wrong or we interpreted his claim incorrectly. In the coming 20 minutes, I would like to make the case that it is the second, and share a bit of learnings that I've gathered while running such an intermediary over the last few years. So here's the paradox. In blue, you can see adoption in terms of Bitcoin holders worldwide over the last few years. So we went from 50 million in 2019 to about 500 million by 2025. In orange, we see the annual revenue of Coinbase, which is the largest publicly traded broker in the world and whose revenue is consistently made out mostly of Bitcoin. So it's a proxy for the market, but the rest of the market follows a similar pattern. So with the exception of the outlier in 2021, we can clearly see that over the last decade or so, we had a correlation between Bitcoin adoption, in terms of how many people are effectively having Bitcoin, and the revenues of these middlemen. So clearly, there was some kind of paradox or misinterpretation here. So let's go back to the white paper. What Satoshi told us, let me go here so that I'm not standing in front of the desk. So what Satoshi told us is sent directly from one party to another without going through a financial institution. This is true and this is happening. So the promise that was delivered was indeed to remove middlemen at protocol layer, but at protocol layer only. It doesn't mean that there was so all middlemen would be removed up to the user. This is very important. Somewhere between 2008 and 2017, there were claims that were exaggerated that we would remove all the banks, that all the institutions would leave, and that there would be no more place for such financial institution in between. That is incorrect, as the data shows, and as I will continue making the case. So, Satoshi was right, but that was a different claim that he was making for a different stack on the layer. All right. So here on the left, you have the actual things that Bitcoin is doing. Trustless, permissionless, final settlement, this is happening. However, what users require is also something different. They want to be onboarded. They want customer support. People in this room know very well what is a seed phrase and UTXOs and public addresses, but most people don't. And they do not know that, they do not want to know that, and honestly, they do not even need to know that. This is very important. There's a part that Bitcoin does, and does it very well, and this is exceptionally valuable, but there's also the part that Bitcoin does not, that we should not forget about. All right. I would like to go back in time 1 or 2 generations. For those of us who were born in the 80s or before, you might remember that when the internet protocol was developed, there were actually several fighting each other. So TCP/IP is the one that came out as successful, but there were alternatives. The same when we came up with emails. You know, there was SMTP, the one that ultimately came out of it as the winner, but there were alternatives. So there was a protocol war. There were layer 2 solutions built on top of the base layer. That might remind you of something else we are more familiar about with these protocol wars and layer 2 solutions. This, some of you may know about, but 99% of the people do not know or care or need to know about this. What they care about is this. They open an email to Mama, content, I love you, send, and that's it. They do not care whether it's TCP/IP below it, they do not care whether it's SMTP, and they do not need to know. This is a mistake that many people are doing in the Bitcoin space, thinking that you will manage to make 99% of the population hardcore Bitcoiners and freedom maximalists and libertarians and so on. People don't care. What they want is something that works. Simplicity. This is the key feature that people need, that people want, and this is the future that the middleman is bringing. All right, so some people did figure out, some institutions, banks, corporates did figure out that there is this need for simplicity. You have some of them, the Bitcoin-only brokers like we are, you know, ideologically aligned. You have now traditional banks coming in order, again, to provide the simplicity. You have some others activating, you know, the different services of Bitcoin in their stack. So this exists. They will not disappear. They will continue to exist because users will continue to request and need the simplicity. I always need to go back and forth because the pointer is not taking the click. So this is not a pitch deck, so I'm not going to speak much about Relay, just giving you a few items to give you a feeling for the size of what is it that we are doing. So we have reached now over 100,000 registered users at Relay. That's 100,000 people, most of which had never had any Bitcoin before coming to us. 100,000 Europeans that now have some Bitcoin in their pocket in self-custody, because we do self-custody only. $1.4 billion of transaction have been made via Relay, and in a good month, we reach almost 100,000 transactions just on Relay. And again, we are Bitcoin only, meaning that there are many others that are bigger than us, but also including more coins. And we are not the only Bitcoin only out there. So the middleman is not something to be feared. We are bringing something to the market. We are bringing coins in the pocket of hundreds of thousands of Europeans that wouldn't have Bitcoin in self-custody otherwise. So, yes, as a regulated entity, we are a potential point of attack. We can be regulated, and we are. We can be frozen. So far, so good. We are not. We could be shut down eventually, depending on politics and how the world evolves. Some people publishing free code online have been put in jail in other countries, even though they were following the rules. So this is not things that are impossible to imagine. However, even if we are a point of attack, we are not a single point of failure. You can use Bitcoin many other ways. You can get Bitcoin in many other ways. You can work for it. You can trade your energy, your skills. You can share anything that is valuable to have Bitcoin. Bitcoin will be valuable because also it cannot be taken from you by force, by government. So even if there are middlemen, Bitcoin, the base layer, will always be there, will be valuable, and having more people with Bitcoin in self-custody is a success in itself. We also know that Bitcoin is anti-fragile. The more you attack Bitcoin, the more it comes out strong out of it. We have seen that with the block size war in 2017. Before, we didn't really know what was Bitcoin. Some big corporates were trying to move Bitcoin into a different direction, but as Knut showed or mentioned this morning, it came out stronger with an insistence on the easiness of running a node, so that the network could stay decentralized. Bitcoin comes stronger out of every attack that you throw at it. This being said, we need to continue being on the lookout. The fight is never won. We need to continue fighting because there will be other attacks. There will be other things that will threaten Bitcoin. We also had the speech from Luke on cybersecurity. We are never out of the woods. We need to continue fighting for freedom. Now, regarding the middlemen, as I mentioned, middlemen are not dead, and I would like to argue that they are not going to die anytime soon. The thing is, they need to continue evolving. So for now, the model of brokerage, so on-ramp, off-ramp of Bitcoin, has been working very well for some people in the space. However, that's not going to work forever. As Bitcoin evolves, the complexity of users, of their needs, will continue to evolve as well, and we will need to increase the services, to improve the product mix, and to deliver new things to Bitcoiners and to people all over the world. What doesn't change, however, are the values. So we will stay Bitcoin only. Many others will stay Bitcoin only. We will stay in line with self-custody, because this is what brings the freedom to opt out of the system. And we will continue to offer simplicity to the user, because that's what they are looking for. They are not looking for the SMTP stack, they are looking for the email. So, in short, the middleman isn't dead, and is not going to die anytime soon. He's not the future of money, he's the bridge to it. The middleman is the adoption. It is via middlemen that we can bring Bitcoin to thousands and eventually millions of people all over the world. So it is very easy to believe the optimistic claim that Bitcoin will remove all the middlemen, that we will all trade in peer-to-peer without anybody in between. But I don't see that happening too soon, unfortunately. There will still be the need for the simplicity that people need to go about their day. The middlemen are the enabler. So in the meantime, we keep building, we stay vigilant, and we continue stacking sats. Thank you. All right, any question?
Yes, thank you for your presentation. It was really great. And one thing that you said that really resonated with me was this kind of ideas about simplicity. I design a lot on Cashew, and Cashew is a custodial solution. And when you build custodial solutions, you have the kind of opportunity to make difficult things easier at the expense of custody. You mentioned that self-custody is one of Relai's core principles. How do you make that simple? What are you guys doing to onboard those 100K people and then give them self-custody? Are you doing cloud backups? Are you putting it in Google Drive? Are you doing the traditional 24-word seed phrase? And do you fear that giving them kind of this power when they're this early on in their journey might be a risk to them that you're kind of putting them towards?
Yep. So as Luke was saying earlier today, every cybersecurity is a trade-off, so every aspect of it. Indeed, we are creating some solutions for them to be able to retrieve their seed words if they choose to opt in a simpler way than just writing down 12 words. However, this comes at, with some risks. So one of the things that we are doing, and we are the first one in Europe doing that, is using Austrian provider called Keyless, with face scan, but also a very advanced version of face scan combined with liveness check and other things, you can retrieve your seed words. Optional, so you can choose not to have that and to stay on your 12 words. But I believe that the market will evolve in that direction. Eventually, people will just want to use Bitcoin in order to have their savings protected from inflation, and they will not care or need to know what is a seed phrase or anything else. Does that answer your question? Thank you. Yes?
How does it work with the can you get more in that?
Okay, we are at a Bitcoin++, so I should know the tech more in detail. However, for this, I will need to go to our tech guys or CTOs.
Just to clarify that, it's still a thing where we don't have to trust you or the Austrian provider with our secrets?
No. It is made in such a way that we have nothing. We don't even have a part of it's not even half self-custody or partial. We have nothing. There is no way for us to retrieve your keys or our providers. It is fully something that only you can do. So fully self-custodial by design, and we are staying there. Yes?
If you guys go down, what can I do with my 12 words?
So, great question.
Go to another provider?
Yes, great question. And this is indeed core of in our offering. So the fact that we are focused on self-custody is also due to the fact that we know that as a single point of attack, we could be seized, attacked in any other way. Even if we go bankrupt or if we are hacked or anything happens, nothing happens to your Bitcoin. You and only you have access to it. You have your 12 words. You can go to any wallet and retrieve your Bitcoin. You do not need to use the Relay wallet. It is just there for your simplicity, but you don't need to use it.
Maybe again, very quick. Do you give any yield or anything to users? No, right?
Nope. No. And honestly, I would try to recommend to people to stay away from yield. Honestly, Bitcoin has been growing at, 50% year over year over the last decade or so, possibly more than that. If you try to get another 2% because of the yield and therefore put your entire stack at risk and trust somebody in between, come on, what are you doing? Just buy the real stuff, stay there, self-custody it, and so you do not need to have this extra potential 2% at a big risk.
Slightly off topic, but when you recommend to stay away from yield, do you also include the American fella down in Florida, I think, that promises 11.5% annually with Stretch?
All right, this is a much bigger topic. This is a financial engineering topic that we might get into, but then I would need another hour or so presentation. So this is something that we can discuss over dinner.
He recommended to stay away from yield with other Bitcoin products as well. So,
well, the thing is, Stretch from MicroStrategy, it is not that you are giving your Bitcoin and you get a yield. So you are buying a fixed income instrument that is backed by something. It is backed in part by Bitcoin. It is backed by many other things as well. It is multiple times over collateralized, and therefore there is some justification that you run a very low risk in order to get that return on your fixed income investment. But this is not a yield on Bitcoin. This is a fixed income instrument that is backed by a company that has Bitcoin on its balance sheet. Very different thing.
Yeah, thank you. Hi. So you mentioned Bitcoin only a bunch of times. Looking forward to other talks we heard, stablecoins on ARC, for example. You have any thoughts? Is Bitcoin only? Does that mean mainnet Bitcoin only? Or would you considering branching out if the underlying security is still Bitcoin?
In all honesty, this is not a conversation that we have had in details. We stay on the high level, so Bitcoin is the product that we are delivering. We are striving to be the Bitcoin app in Europe. Now, I cannot completely rule out that we would not accept, for example, stablecoin in the future in order to get into Bitcoin. So instead of accepting the fiat, you can go from the stablecoin side. I don't see stablecoin as a, as an altcoin. This is really an alternative to fiat. But yeah, the Bitcoin-only spirit and the ethics behind it will remain.
Okay, then I ask you again after IPO.
Hopefully 2030.
Any other question? Okay.
All right.
And thank you for the great presentation.
Thank you.
Okay, hey everyone, we're gonna get started. I'm very excited to introduce Jos, who is here from BlockRise, and he's going to be talking about, are we building the products that Bitcoin deserves? So please help me give a warm welcome to Jos. Thank you.
Well, yeah, thanks for being here. I know it's very warm, but I'll put it on anyway. Are we building the products that Bitcoin deserves? I mean, I'm having a lot of conversations here about all the technical cool features that Bitcoin can support and that we can do. But I'm taking a bit of a controversial stand here, and I'll defend that we really need to focus a lot more on the adoption and the user side of things, so that we run into scalability issues, and that makes more incentive to fix things on the network. So I think that coming from a Bitcoin perspective, so I'll tell you more about myself later on, but I'm a 2013 Bitcoiner, and the conversation has changed. It has changed a lot. The first few years was a little bit more rough and really a lot more technically focused, but especially over the last 5 years, Bitcoin has won far more monetary arguments than a lot of people tend to say. And this is something we can be very proud of, but now it's time to move on and really start focusing on the necessary products, and I'll walk you through that. But first, just to put it a little bit in perspective, I think most people know already, but adoption is actually there. I'm not saying it's the right adoption. It's mostly short-term
product features that we're seeing, such as ETFs, just giving speculative exposure to Bitcoin. But I mean, we shouldn't complain too much because people are interacting with Bitcoin and they're getting familiar to, seeing how volatile is it and what is it. And what we see with clients often is after they do their first purchases on maybe a centralized exchange, they start reading up on books and watching podcasts. So the adoption in a sort of mental way is getting there. There's more than 100 billion in volume over the last 2 years now, 2.5 years in ETFs. There's estimated 106 million users who have interacted with Bitcoin. And every day there's more than on average 602,000 transactions happening on Bitcoin network. I mean, these are quite impressive numbers. However, exposure is what we're currently mostly seeing. I mean, everyone knows the most trading's happening off-chain. They happen on exchanges. Imagine, just for a brief thought, that every trade would happen on-chain. I mean, the network wouldn't be able to handle this at all. So to some extent, it's good. This is part of adoption. So exposure I see as a good first step of getting people familiar with what is it and getting them in the system of reading upon it and learning and talking about it. Then second, this is a bit of the phase. This is the phase where we are now, is verification. So we're seeing platforms such as institutional custodians where they allow for verification side of things. So imagine with an ETF, you cannot verify your own Bitcoin holdings within the ETF. I mean, some provide a proof of reserves for the entire ETF, but not on user level. There is a trend going on with institutional custodians like BitGo where they offer verification. So they don't give you the ownership yet. You cannot sign for your own transactions directly, but they allow you to verify it direct, like segregated wallets, etc., which is great because this prevents paper Bitcoin kind of situations. The vouch that I'm pushing for, also from my company's perspective, is ownership. So in the end, we need to resolve in a way where ownership goes back to the users, whereas ownership meaning you can sign for your own transactions, you can verify the ownership yourself independently, and this is a critical component of getting Bitcoin adoption properly in. This will further prevent potential like off-chain shizzle that might happen. So very briefly on the monetary assets, I've seen this slide or similar slides across the day already. Well, half of the slide doesn't show, but anyway, the idea is there's fiat, there's gold, and there's Bitcoin. And I mean, it's very clear that the monetary properties of Bitcoin are strong, are well defined, are generally accepted by people. It's just that for successful monetary asset to function across the economy, we need general acceptance. And that is still where we see a lot of it is lacking, and where we can win so much is just move Bitcoin in a way that a lot more people are accepting it as a monetary asset. So this is exactly what I'm missing for most of these conferences and companies is, they're making a choice. Either it's extremely convenient, it's an app that you can install in seconds, but it's compromised in a way that you surrender to either verification or to ownership, and it's just a speculative exposure. So you usually see that there are shortcuts being taken, etc. This is very much the early days. Whereas on the other hand, we are seeing great hardware wallet solutions, for example, that are very principled on, self-custody, and this is the only way, and decaying wallets, I've heard a lot today. But like, generally speaking, I've always given the example of my mom. Like, my mom is also a 2013 Bitcoiner. She loved the idea, how I explained it from day one. It's just that I really don't see her managing a hardware wallet comfortably for her savings account. So this is a general challenge that I see that is not being focused on. I mean, everyone is being harsh on the entire community. It's like, yeah, you need to do this, you need to do that. But honestly, I think that there's a massive gap in there where there's room for solutions in between, basically, of these two that will help with adoption, will prevent big failures like we've been seeing over the last years. So briefly on the Blockrise side of things, we just rewrote our mission and vision statements. Whereas we're saying we're making Bitcoin accessible without compromising what makes it valuable, with a vision statement that is Bitcoin ownership for everyone. So basically what we do with Blockrise is we invented a semi-custodial solution, which exactly fits in the middle of the two situations that I was just talking about, with the idea of we have the hardware wallet, you have the access to the hardware wallet. So then in an institutional way, we have a hardware security module, the clients hold the access to the hardware security module, meaning they rely on us because we host the hardware, but you can cryptographically prove that we cannot access your Bitcoin. And this is, I'm not saying it's a perfect way, but it's an approach of helping user adoption, but remaining the ownership with the users, because again, you can cryptographically verify that we cannot access your Bitcoin. It's just that you rely on us. But yeah, I mean, the regulator had a lot to say about this as well. We had a lot of fruitful discussions about it. They wanted to name us as a non-custodial company, which I don't fully agree with. But this is a principled solution, just trying to throw at user adoption, similarly to what BitKey is doing, in my opinion. So I know that there's a lot of Bitcoiners out there that disagree with the stance of BitKey, but what I really appreciate from them is that they're trying to approach a custody way that doesn't have to deal with seeds, because seeds are a terrible security practice. I mean, Bitcoin Core doesn't support seeds for a good reason, so we should consider similar and think out of the box and rethink from scratch. I mean, for the rest, I think there's quite a lot about Blockrise. So started in 2017, Bitcoin-only company, regulated for EU, based in the Netherlands. We've been around for 9 years. We're only kicking off now, basically. We first wanted to build the entire tech stack, then all the regulatory licenses, and now we're going at it. And a big thing was announcing bank accounts. So full deposit guarantee bank accounts have been live since 3 weeks. So what we're trying to achieve is building a Bitcoin bank, like semi-custodial solution on the one end, a fully regulated Bitcoin bank account on the other hand. And by the summer, we start mixing those things with Bitcoin backed credit cards. We have Bitcoin backed loans already active, but they're not for consumers yet because of regulatory challenges. So yeah, so the development that we see is, you know, first people, they hold Bitcoin, which is great. Then we're moving into the liquidity side of things, like trading integrations, etc. But in the end, we want to integrate it in full financial inclusion, as in being able to open mortgages, get liquidity, and have Bitcoin act like proper collateral. And again, I think that a lot of the solutions, they're looking at many things in the total scope on the regulation, for example, but the user understanding side of things is just terrible, simply said. Where's the time? Oh, okay, I have plenty of time. Cool. So coming back once more, legibility, I think that this is something that a lot of companies still underestimate, or protocols, that if the user doesn't understand what's going on, then it is just like it deems to fail over and over again. This is what we've seen with seed phrases as an example. The amount of Bitcoin that we had to help recovering over the years because people just had bad security practices. They don't fully underestimate it. Like the general public interacting with Bitcoin is really sort of like, yeah, I would say undereducated. We've had last year a case where we had to help someone recover 80 Bitcoin because they used the passphrase and they had no idea that they actually said a passphrase. And if you think that there's something wrong with the seed and having to figure out many weeks later that it was actually a passphrase said 7 years ago, it's quite inconvenient to find out. So I think that we need to go back to scratch, like work from scratch, and actually consider, okay, what does a default user actually expect from this? Like assuming zero to none in knowledge, and move on from there. Secondly, I think that we have a lot to win on resilience. Like things work for one user, or things work in normal market situations, but what we've seen over and over again is that unexpected things happen. And a lot of companies, but also on the network side of things, we are really not ready for this. So we need to think in worst case scenarios. We need to think outside of historical events. This is also something we see every day in our business, is that people really assume that everything that happened basically between 2013 and today, that is what will be happening. But I mean, we need to consider that things change over time, and we can sort of plot forward as well based on historical things, but we should really move beyond just single user testing basically. And lastly, alignment. And I think that this is exactly where the shortcuts are usually taken, that we really need to stand strong for making sure everything is aligned with Bitcoin. Like we call this the core values of Bitcoin, again, meaning ownership, on-chain usage, for example, unilateral exits are things that, you know, we need to remove this dependency of the